Of the Board of call the meeting to order. Thank you all that are on the call, and thanks to board members that are here. So we'll go through our process, and the first thing is a notice to everybody that we are recording the meeting, although the voice just told us that. And so keep that in mind. The next thing we need to do is do our roll call. Lindsay, could I ask you to help us and do that?
You bet. All right. Jack Prothero,
Here.
Terry Cohe,
Here.
Bruce Nelson,
Here.
Diane Fladmo,
Here.
Maggie Peterson,
Here.
Mark Barry, Jeff Meredith,
Here.
and Carl England is absent. Senator Ryan Lynch. I don't see him on, and Representative Ken Walsh, it looks like he's joining right now. So we do, oh, and Daniel Trost.
Here.
Okay, we do have 8 board members present. We have a quorum.
Okay, thank you, Lindsay. The next thing that I'd like to ask for is there any public comment on issues within the board's jurisdiction? Hearing no public comment, we'll proceed. The next thing is approval of the April 20th board minutes. Is there a motion to do so? Okay, is there a second?
Second.
Moved and seconded. Any changes or additions? If not, all those in favor of the approval of the minutes, say aye. Aye. Opposed? Hearing none, the minutes are approved unanimously. Next thing we need to talk about is our administrative business. First thing is our audit committee.
Yes, we had a very brief meeting this morning. I'll cover it very quickly. Dan, our executive director, updated us on the SOC audit, said that they've been working with them for a couple of weeks, and there should be a draft out in August. So we'll see something in the future. So that the LAD will be scheduling time with us soon. Soon, that was the key there, soon. So then Julie gave us an update on the audit checklist, which you've all looked at. We were all at the meeting. She spoke to the fact that the board staff had reviewed all the IPSs and recommended changes to the board for approval this last year, during fiscal year 2022, I guess this year. And she talked about the custodial bank rating review. We did that. They were staff, and Mark asked them to make sure that we were specific as to who was reviewing it. It wasn't us, it was our staff. The custodial bank ratings were reviewed from at least 2 nationally recognized statistical rating organizations, and they were within the governance policy requirements. She then spoke to all of the new GASB statements to be implemented for fiscal year 2022 financial statements. And we had GASB 87, we have GASB 92, GASB 93. Yeah, GASB 97 and some implementation guides. And really, there aren't any major changes at this point. There will be a few changes with regard to the intercap 2.0 in the notes, I think the financial notes.
Enterprise statement financial.
The enterprise, yeah, but just in the footnotes.
Yep.
So this is regarding describing the debt easement that we went through, and then the long-term debt disclosures. She then spoke to GASB 96 and 91 being implemented in fiscal year 2023, and GASB 96, we're currently waiting for Department of Administration guidance on the threshold, so we don't know how that would have an impact. So 91 would require some disclosures within the enterprise statements. So I think that was pretty much it. Anybody else has anything else that I missed?
Any questions for audit? I don't think we have any decisions to vote on, so thank you. The next report is loan committee. So I'll do that with some help with Doug because the full board does need to formally vote on a couple larger loans. But the first one we looked at was a request from Farmers Union Oil Company of Circle. They requested a loan of $2,470,000 for 25 years. And it's to build a new fertilizer plant for them in Circle. That's within the limits of loan committee. Loan committee did vote to approve that. And then we had a couple other larger loans that the full board here needs to formally vote on. Just for the record, I'd like the people to know that the loan committee spends a lot of time on these loan requests. It may seem, if you just look at the board minutes, that it goes pretty fast, but we do take time and do some serious deliberation on these loans. But I've asked Doug to just take a couple high-level things for the record on the two loans that the board will vote on here.
Thank you, Mr. Chairman. So the first one was Jackrabbit Rentals, who were participating lenders from the Bank of Montana. The bank's portion is 2.7 million. The BOI portion is 10.8 million for a total request of 13.5 million. Staff recommended approval. It met the down payment and debt service requirements. It's an established business, good management and ownership, good credit history, and strong debt service coverage.
Questions for Doug? If not, the loan committee did unanimously recommend to the full board that we approve this loan request. But I'd make a motion coming from the loan committee to the full board to approve the request. Would need a second. Is there a second?
So moved.
And seconded. And any other questions or anything? If not, call for a vote for the formal approval. So all those in favor of this loan request, please say aye.
Aye.
Or anybody opposed, same sign. If not, that's approved unanimously by the board and the total loan is approved. Hey, Doug.
Okay, Mr. Chairman, the second request is OSD Tech Campus LLC. The lender on that is Stockman Bank of Montana out of Missoula. Stockman Bank's portion is 50% at a little over 8.4 million. And the Board of Investments portion is also 50%, a little over 8.4 million. Total project was 16,823,000. Purpose was to build the two buildings there in Missoula. The loan met the loan to value requirements and the debt service coverage. You know, the strengths on this one is obviously the major tenant that they have. So that looked like a good loan.
Or any questions for Doug or the committee? Seeing none, I'd make a motion coming from the loan committee who unanimously recommended to the full board that this be approved. And that would be the motion to approve this loan. Is there a second? Second. Jerry is second. Any questions or other comments? If not, all those in favor of approving this loan request, please say aye. Aye. Anyone opposed to it? Well, that request is formally approved by the full board unanimously. Anything else for Doug while he's here?
Mr. Chairman, we don't need, the full board doesn't need to approve the farmers union.
No, because that's under $5 million.
All right, good enough. Thanks.
Thanks for keeping this on track. So in addition to that, the loan committee was busy. And so we had a couple intercap loan requests. The first one was from the Department of Corrections. They requested 1.3 million to upgrade their laundry system. And so that was within the parameters of the loan committee. The loan committee formally did approve that loan. And then we have an ongoing relationship with DNRC. And they had two loan requests with us. One was 1.6 million interim loan that would be paid off when they do their general bonds. And this one, the first request was for the Water Pollution Control Fund. That was approved by loan committee. The second request was by DNRC again, but they requested $2,200,200 for their drinking water revolving fund. And again, within the loan committee scope, loan committee did approve that. So is there any requests or comments or questions for anything within the scope of the loan committee? If not, that's the loan committee report. And so we next go to Terry for the Human Resources Committee report.
Human Resources Committee had a meeting and Dan provided us an excellent update on staffing review levels and also succession planning, which is something that we have asked the staff to be conscious of and keep us abreast of. We also discussed the fiscal year 23 salaries for the 11 exempt staff, and the committee voted to approve those, but we need a formal board motion to approve those. So I would make a motion that we approve the salaries for the exempt staff for fiscal year 23 as discussed in the committee meeting.
Moved and seconded. Any questions? And I'll call for a vote. All those in favor of that, please say aye.
Aye.
Any opposed? Hearing none, the committee decision is formally approved by the full board. Anything else, Terry?
No, Mr. Chairman.
Okay. So we got through our committees. It was a lot of work this morning. The next thing is comments from pension board members. You can set the example for our board member, Maggie.
I gave you all a handout because I knew I was going to be throwing a lot of numbers at you and I didn't want you to write them all down while we were having discussion. Impera board met on May 12th. At that meeting, we had consent agenda, which had two entities adopting the 457 plan, and that would be Teton County and then Sealy Lake, Missoula County Water District. So those were approved. Then we had Kavanaugh McDonald, our consultants, present the experience study for the 5-year period ended June 30th, 2021. The assumptions that they reviewed, just kind of for those of you who weren't at the meeting, included price inflation, investment return, wage inflation, and there's one other variable that really didn't play into anything. They had other assumptions too that they spoke to, but before we got to that, the price inflation, they're proposing that there's no change. It's currently at 2.75%. They recommended no change there. The wage inflation is at 3.5. They recommended no change. The investment return assumption was currently at 7.65, and they recommended reducing to 7.30. The board did approve it. The Impera board did approve that change. The other thing I wanted to present is just to show you what the impact of that change is. And I want to talk about the other assumptions that they take into consideration when they're making these recommendations, and these are demographic assumptions. They use data from Impera on post-retirement mortality, pre-retirement mortality, rates of service retirement, rates of disability retirement, rates of withdrawals, and rates of salary increases for merit promotion. So they take those all into consideration. At the bottom of your page here, the impact of the changes on the unfunded accrued liabilities by plan is listed below for the funding ratio, the unfunded liability, the funding ratio, and the amortization period. So for PERS, which is the biggest change, the unfunded accrued liability is $304,985,287. That's a change in the funding ratio of -2.64. And the amortization period goes from 28 to 37. So statute has a 30-year maximum for amortization period, so they will be doing something with the legislative session, I'm sure, if that's approved to go forward with it. The judges increased theirs by 2,077,659. That's a decrease of 5.2%, and they're already fully funded, so it's not an issue. Sheriffs, just remember, this is a small entity now. The sheriffs is the population. It increases them by 36,603,510. That's a decrease in funding ratio of 5.3. It takes their amortization period from 18 to 41, so we'll have to again bring something forward. Game wardens, this is a scary one. We bring this forward every session as long as I can remember. It increases their unfunded accrued liability by 20,908,978, which is a change in funding ratio of -5.71. It takes it from a 35-year amortization period to infinite. So scary. Anyhow, then Highway Patrol was next. The increase in their unfunded accrued liability was 15,979,963, which is a decrease in funding ratio of 3.98. It takes their amortization period from 26 to 62.
What?
Again, it's a small,
Is that what?
it's a small number.
Does it have anything to do with the age of the people in it? or
Well,
is
those
it
all
just-
play into it, but the amortization period is because it's a small group. And when you make this kind of a change, it's the sheriffs and the Highway Patrol are both in that same boat.
To put it in perspective, you throw a couple $100,000 at that and it goes away.
It helps. Whereas in the 304 million on ERS, it's gonna take a lot more.
We're gonna ask Putnam to write a check for that.
Yeah.
Municipal police officers, it increased their unfunded accrued liability by $50,212,742. That's a change in funding ratio of -5.01. It took their amortization period from 15 to 26. Firefighters, it's an increase in their unfunded accrued liability of 61,705,334, which is a decrease in the funding ratio of 7.49. It took their amortization period from 6 to 14 years. And the bottom one's the firefighters. It was very minimal. As you can see, it just stayed pretty much.
Jeff, we just scanned these to you, so you've got them.
Oh, sorry.
Thanks.
Oh,
Did you write all those numbers down, Jeff? Just kidding.
I was listening to him rattle off there.
Sorry.
So that's important information. Is there any implications directly for us at this point?
Less pressure on us. No, I'm just kidding. For
Less
investing.
John's hurdle got lower.
Gonna have to sell the Tesla.
If anybody's interested,
Sell the kids first.
If anybody's interested, I do have a copy of the slides that Kavanaugh presented at our board meeting. I'm happy to leave those with Dan, and it's very interesting. I just pulled out this bit of information, so they go into much more detail in what they presented.
Thank you, that's really helpful.
So we had a very similar meeting with Kavanaugh at TRS, and I'm pretty sure, I can't remember the numbers because I didn't know we were gonna have this conversation, but we, I think, are still under the 30-year threshold. I think we're at 28. 27 was it? And we might have gone from 23 to 27, if I recall, something like that. Yeah,
So the teachers made the same investment assumption.
we did, and we approved that also. Yeah, and that obviously was the big driver. The others were kind of a wash. There were a few things that helped us, a few things that hurt us in the amortization period, but the investment change was the big driver of that for sure.
And that's really the point of doing these studies together now instead of doing it separate like we did in the past.
You know, they could have made these reductions when markets was.
And all the losses cooked in one year.
So
But those are
prior
some-
to this, you were at different rates, right? 7 point.
7.5 and 7.65.
Yeah.
They had dropped theirs a couple years ago, right?
Well, you both dropped at the same time. It's just they dropped further than you dropped. And Jack, to your question, the impact on us is we'll probably have to do some fiscal note analysis on the bills that come forward from Impera. And to the extent there's any additional funding,
And
it
just-
could range anywhere from full funding for small systems to,
Infusion.
make infusion for the larger ones, but not necessarily a lot more work.
Just
done.
remember, this is as of June 30th, 2021, too. Things have changed. So if they were to do that study today, they'll have the new study in October of dated June 30th. That new evaluation will come out. It'll be evaluation, it won't be experience study again, but it'll be the evaluation. Yeah, so we've got a lot of work to do, John, between.
Mark?
Did your boards discuss legislation to address the shortfalls?
We didn't discuss specific legislation, but Dory, Executive Director Dory Schwinden did speak to the fact that we have a responsibility, fiduciary responsibility to come forward. He was going to the SAVA meeting today to speak to what kind of legislation they might be bringing forward, because you have to find sponsors for some of those. And
Well, typically what they do is they'll get the experience study now for future evaluation studies. And then, Dory, Bill put their thinking caps on and go back to the board with, here's a couple of options we think could fix this. Because the board has to request the legislation on behalf of the organization. So I'd say probably September, October timeframe, you'll have some sort of funding proposal to bring to SAVA.
we did speak to our responsibilities to do that, though. If it's over 30 years, we have a responsibility to try to do something.
Any questions for either member? If not, thank you. I guess we should have warned you that you had a little report, so. That's traditional every time. Okay, so it's not a requirement to read that book, but it is a requirement. So the next thing, I think Senator, our Representative Walsh is here. Representative, do you have anything you'd like to talk to us about?
Well, after hearing about the pension funds, probably be interesting conversations going forward there. So that's all I have as a comment today. So thank you.
Okay, thank you. So I think we've covered everything we need to on tab 1. So we'll move on to tab 2, which is the Executive Director's report. Dan?
Thank you, Mr. Chair. Ethan and Halton, if you could come in here for a sec. We have 2 summer interns who I want to introduce all of you to. But as they come in, just FYI, the April monthly snapshot was left on your seat today. I have included the memorandum from PEG about the Montana buildings. As you can see, very good investments, good IRR. Stop there. Any questions on the Montana buildings? Within those particular assets?
Go ahead, Terry first.
What is the plan on the California street land?
So I think we talked about it last meeting. I don't like how we only monetize the buildings. And I think we need to monetize more. So we, as part of that energy project, that with the energy audit we have going on, we asked them to look, hey, could we do solar panels in the parking lot? Could we do solar panels over there?
Yeah.
What they found was we've got, not only for emergency operations purposes, do we need that backup and redundant power. We'll need backup and redundant internet. But the most cost-effective way to get there was not to put some diesel generator or something in the back. It was to do those with the battery backup and to just put it on the roof, not to put it on the parking lot or the California street. So California, we entertained 2 years of conversations with the school district on a swap, got absolutely nowhere with that. I'm hoping maybe one of the new school board members wants to sit down and talk about it in a garden at some point. I don't know. But that is it officially. Our problem, I think, on the California street right now is we've always had a positive IRR on that property until this last valuation from DOR, but we're a year lagged with reappraisal.
Yeah.
So I have to believe that we're still positive on that, but in that 2 or 3%, not in the 7 or 8. So that's one of those, if the right opportunity comes along that also doesn't impede the value of this property, because we do have this easement on the far side of the building. I don't know why, but that's where the air intake is. What we don't want is a bunch of buses and carbon monoxide fumes in cars going right by our air intake. So to the extent we can turn that into a valuable asset, either sell it off, lease it, put some value add on it, we'll do that. Just haven't had the right opportunity yet.
Thank you.
You have a question?
Are all the buildings fully leased?
They're all fully leased. We got that done 2 years ago. Most of the leases are on 10 years, which would run through 2029. There's a few coming up. The escalator we've used is 3%. So some have a legacy 2%, but as those come up, we'll be implementing the 3%.
Okay, thanks.
Ethan, why don't you go first? Just introduce yourself.
Yeah, so I'm Ethan. I'm an intern here. And yeah, just super excited to be here. Go to school at MSU and one more semester left. So
What are you studying?
I'm studying finance, so, and a minor in small business and entrepreneurship.
Where are you from, Ethan?
Originally from Atlanta, Georgia, so a long ways away.
And you got it up here,
Yeah,
just to get away from the hot weather.
kind of. I also had some family up here, so I would visit them, and I kind of wanted to go to school out west. And yeah, it's been a great opportunity, and yeah, it's just been fantastic, and I hope to be able to stay here. So
I'm Halton. I'm also one of the interns here. I'm from Missoula, so a little bit more local. I also go to school at MSU. I'm a junior, so I still have a couple of years left. I'm also pursuing a finance degree, and I have a couple of minors. I have a minor in China studies and a minor in international business. So yeah, and I'm also equally as excited to be here. It's really great so far.
And
He will not be our lead opponent in legislation.
what is the term of the internship?
Typically mid-May through late August.
Well, welcome aboard and you came in the right direction from Atlanta. Coming west.
yeah,
Good for you.
Thank you.
you all.
Budget status fiscal year to date. So we had to do a little bit of tweaking to the report that we typically would pull from the state accounting system. At the beginning of the fiscal year, the Department of Commerce, when they were inputting our budget, left out about $240,000 that we were budgeted for. So the numbers to the right, where you see percent of correct budget spent, that's the actual numbers versus what we were fully budgeted, not what was entered into the system. So you can see we're in a pretty good place. We've got personal services budget. We've got 3 payrolls left, so we're sitting in a decent place. And I think the last payroll will actually hit next fiscal year, at least in part. The operating expense, you can see we're doing very, very well in the operating expense. Investment operation. So, from a budget perspective, we're sitting in a good place. My goal and what I'll be bringing to you for the next legislative session request is no adjustment in our charges and our fees, with 1 additional FTE for the investment staff, which we would not ask for additional funding for. We use our existing budget authority to do that. On the side, we've been managing our 60-day working capital limitations as best we can. However, finding out in April that $250,000 you had that you didn't know you had appeared made it a little more difficult. So how we've been handling, as I discussed earlier with you all, any 60-day working capital issues is we do dividends back to the participants. So our total dividends this year will equal about 20% of our total operating budget. So, a couple of things have been driving that. One, we've been able to contain costs because we thought we had to manage to $240,000 less. 2, as we get these additional assets, so for instance, the ARPA funds, that's an additional pool of dollars to bill personal services and operations to. So big chunks of Doug's time, some of mine, accounting's time. So as we get these additional assets to build toward, everyone's fees will go down. So as of this year, we'll be down 20% for operating fees that we've charged to our participants. I don't anticipate that going on forever, but it at least, I think, can get us through next session with our existing rate structure. Fiscal year, I'm sorry, any questions on the budget?
So why does the debt service number look so strange?
Because we defeased everything, intercap 2.0, all of that.
Yeah, thanks.
And that will change a lot in the next month. Mark?
One question. Previously, we talked about retrofitting lights in this building, that sort of thing. That's not in this budget.
No, that was, so if it,
And if you have budget capability, why don't you move forward with that?
adjustments to the facilities are a trust fund expense, not an operating expense.
Yeah. And is this is run on May 6th. So is this through May 6th then?
Yes.
I have a quick question.
Yes,
As we lose our funding, or how will that affect our operating expenses and salaries going forward?
So ARPA and CARES collectively over the last fiscal year have provided another pot for us to build toward. You know, the second component rolling in June will at least get us through next fiscal year. And then we'll be able to bill against those at this point forever, because we will be getting those repayments and still doing time. So the other piece, the other significant piece, which we cannot have cross subsidization on, is if we take over any management of investment services for the DC assets. If we do that, we will bill those distinctly like we do ARPA as well. So there's additional resources to be had there. So, you know, again, if the more pools we can build toward that fit within our core competency, the lower everybody's fees across the campus will be.
I was wondering, with the opioid settlement, if, as that comes, will we be able to bill against that?
Yep.
That's what, 260,000.
400 million.
ODC project plan, how is that coming, or?
So the deputy director of Impera owes John and me and Becky and her team a draft MOU this week. We'll then review it, do some of the fine tuning. My goal is to have a special board meeting in June, shortly after Impera's June board meeting. They'll take it up as an action item, then have a special meeting of this board shortly thereafter, hopefully coinciding with revisions to the remainder of section 10 of the governance manual to wordsmith that.
Make sure Carl's here for that.
Yeah, I've been already given instructions. Carl's has to be here and someone else has to be overseas. But we'll probably need a special board meeting in June to take a look at that MOU. And then start the planning. We'll be out in Portland for our annual asset allocation conference, plus 1 day for DC lineup conversations in late August, early September.
For next biennium, you're going to ask for one more FTE.
One more FTE, but no funding.
No funding for the FTEs.
We'll use this existing budget slack to cover it.
And to go back for it, so with the memorandum of understanding at the June vote, is that when the vote will occur, whether both boards have agreed to?
Right, so Dory and I will bring to our respective boards, him first. We'd like to implement this memorandum of understanding for manager selection and investment lineup for the DC assets. After they approve it, then I'll bring it to you. If they don't approve it, see you in August.
At that time, will you also, I know you all have been working on like the process, the plan, and what you have to do. Have you made inroads there? I mean,
The MOU will contain that process. And then, we're anticipating sort of a longer conversation with Becky and her team on, what that lineup looks like. Hope to nail down in this MOU what a transition period looks like based on Impera's notification requirements to the members.
because I know that's a question that came up at our last board meeting. What's the time frame?
John does not need a summer. He'll be fine.
And the savings for the DC plan participants would be in expense ratios. Is there also a savings at the third-party administrator level where they're helping to make these investment decisions?
So that's what we don't know yet. We've done a quick review of the manager expenses, and we absolutely believe that we can get lower costs for the DC participants on that side. Third-party administrator, a little tougher. What does the custodial fees look like? Is there any wiggle room on that? There's a stable value fund where we have State Street. They're the manager, or they're the custodian for the stable value fund. Is there some leveraging we can do there to get those fees down? I think at a high level, we can get the manager fees down, and anything on top of that would be great.
So to your point, were you talking about what Empower does for the plans? We'd still have those fees. Because they would
Unless
still be the
unless they're
record keeper.
charging something for the investment selection.
We asked that question. I was just trying to remember the answer. I didn't think it would be any reduction.
Not that I'm not going to try.
I know, okay, and I expect you to.
And then the last item under tab 2, and I apologize for being so long. Board policy manual review. We sent those policies to you in a separate mailing. We got all the way through the audit charter, so between section 10-100 and 10-161 that we would ask the board to approve with some commas and one line.
And there was one line that we were going to take out that said, although a list is included in the policy as a reference for the travel. We've forgotten to take that out. I know we said to take it out. But,
Anything else that you really found, Maggie?
no, just punctuation type commas and that kind of stuff. I thought it was. we agreed to. Do you have something more?
I did.
I'm talking about policy 10.140, D3.
Very last sentence on the page.
I just crossed out, because I know we crossed it out, although a list is included, we just said the policy is a framework for the types of opportunities the board members may use in their fiduciary education.
Yeah, okay.
I think most of us were involved in reviewing that. Hard process, but important. Do you think, Dan, we could just approve them all in one shot?
Yes.
So I'd introduce or entertain a motion to approve the changes.
I would make a motion that we approve the changes with the minor edits that I have provided to them.
Second. Moved and seconded. Any other discussion? If not, all those in favor of changes to the board policy manual, please say aye.
Aye.
Any opposed? If not, the policy manual review changes are accepted unanimously. Anything else? Dan? Well, it seems like we didn't pick on you.
Again, I sent Doug in to wear you down.
And it worked. So the next thing, I think we can move on to RVK's report. I want to say thanks to Becky for coming. It's good to see you. We much enjoy you over Jim.
Jim is online, as you can see.
Oh, did Jim hear that?
Pleasure.
I did hear that and I'm struck to the core.
He'll be recovering during my presentation.
So certainly, Jim, you can make your comments as you wish, but I wouldn't interrupt the boss if I was you. So Becky, I'll turn it over to you
Thank
and
you so much. Mr. Chairman. Well, we're behind tab 3, and as you know, we've got 2 sections of our report. I'll probably spend a little bit more time on the first section than we normally do, because there's a lot to talk about in the market environment. This report feels like very old news based on what has happened since the end of March. So I don't know if you want to start with that news where we are today and then go back to March, or if I should end with that just positive, cheery note. Maybe let's give the bad news first, right? In terms of what the markets have done, if you look through the close of yesterday, certainly this wall of worry, the markets are climbing about inflation, the war between Russia and Ukraine, the worries about whether the Fed will be able to successfully help us through this period of inflation and bring it down so it doesn't squelch economic growth. There's just a number of things investors are worried about. It's also one of those periods, one of the most historic periods where equities and fixed income are down simultaneously as significantly as they are. And to give you those numbers on a calendar year to date through yesterday, bonds, the aggregate that we compare in your performance reports, is down almost 9% as a result of interest rate increases. The S&P is down 17%. So if you look at how much those have changed since the end of March, the S&P is down almost 13% from the snapshot you have in front of you, and the aggregate is down about 3%. So again, interest rates are moving. We've seen the reaction of concerns about commodity prices and inflation and conflict, obviously on the eastern side of Europe, but non-US markets have been hit as well. So yet through yesterday, the EFA is down 13.2 and emerging markets are down 16.8. So that means in the period since the end of March, EFA is down almost 8% and emerging markets are down about 11%. So we're not done with this price reset, if you will, keeping in mind all the tensions and the pressures that are on the economic front, as well as the political front, and the cost of goods, the commodities markets, which are driving a lot of the inflation that we've seen. If you look at one market that has done well, what would you guess would be an investment that is doing well during this period? Commodities. So if you take Bloomberg's commodity benchmark, it's up 6% since the end of March and up about 33%. So when you have an inflationary environment like what we have today, you'll find that stocks and bonds are going to be under pressure, and things like real estate and commodities tend to do very well. And the good news is you have exposure. And because of that, relative to the size of, for example, real estate investments with other funds, that's going to help you in your relative performance, and it's going to help you in your absolute performance during this period of time. So if with that cheery introduction, let's go ahead to section 1 and the page that with figure 1 that talks about the markets in March. I've mentioned some of the pressures and concerns that are in the marketplace. The Fed's release of notes today has indicated that they are absolutely committed to fighting inflation. I think many felt that they were a bit late to the party in realizing that inflation is more persistent rather than transitory. So their bite-size interest rate increases are going to be more like 50 basis points, and they're going to be at it fairly aggressively as they try to fight this inflationary force. So when you look at figure 1, you can see the commodity benchmark through the end of March doing very well. And basically every risk-oriented asset class was down during this period. So that continues as we pass the end of March. If you look at the inflation expectations on the next page of that chart, of this section, you can see in figure 2, rising inflationary expectations and break-even rates. This is really telling you what's happening if you look at TIPS yields versus treasury yields. Now, keeping in mind when the Fed is active, you have to take some of those indications a bit with a grain of salt. But when we look at this and the upward sloping of the inflation expectations, it still isn't anywhere near the 8% where we are today. So interesting, the Congressional Budget Office just released a report that is putting some pretty great faith in the Fed's ability to negotiate a landing that doesn't kill the economy at the same time. They're still seeing economic growth in real GDP of somewhere around 3% this year. And, continuing into the next couple of years at the rate of in the 2% range. So obviously that is yet to be seen. It was a lot cheerier than I think people expected because they think that the economy is still fundamentally healthy. So again, a lot of uncertainty at this point, but the inflation that we're experiencing right now has been fairly extreme, as you know. Just to give you another quick factoid that you may not see in some of the news, and it isn't in these reports, but it is in some detailed reports in just a second. If you look through yesterday, the CPI, the headline is running at 8.3. At the end of the year, it was 7%. So it's been up 1.3. If you look at the core inflation that strips out food and energy, it's still high, but it's significantly lower. It was at 5.5% at the end of the year, and today is running at 6.2. So you can see how important those two sectors have really been in terms of influencing the inflationary outlook. And in fact, in some of the materials that we put together on Ukraine, we actually took inflation projections and found a source that showed and predicted where inflation would be with oil at different prices, up to 120. And you can see that inflation could get up to 10 if that were true. And then the reverse, if it were to actually moderate, you'd be down in inflation levels around lower than where we are today. So I just wanted to give you a sense for how much was being driven by what you're seeing at the gas pump every time that you go. In terms of additional information in this section of the report, on the next page, you see a bunch of economic indicators. And another thing that's important to note is how much interest rates have gone up. If you look at the Q4 2021 for the 10-year treasury, so it's the third row on this page, it was running at 1.5%. At the end of March, 2.3, pretty significant increase, and now it's at 276. So again, that's what's influencing the price of fixed income out there. And if you look at 30 years, it was at 30-year treasuries at the end of the year, it was at 2.1 roughly, and now it's almost 3%. So again, significant changes. Sometimes when these interest rate environments change more slowly, it's like the frog in a pot of water. You start cold and then start turning up the heat. In this case, the heat is being turned up pretty quickly. And I just wanted to highlight what some of those numbers were. If we look at what's happening on the unemployment picture, that's also what's influencing inflation is wage inflation. We've got a very hot job market. It is very difficult for companies right now to hire. The prices of those resources keep going up. And if you look at some of the other indications down here at the bottom, you can see what's happened to the price of crude since the end of last year. It was 75 and then it spiked up to 100. So certainly a very different economic picture than what we saw, say, a year ago, if you were to go backwards into 2021. As we look at how our fiscal year is stacking up, you can see that in the bottom section of this page, of course, for the quarter, a negative return of 2.99%, which just is a little bit behind our benchmark and ranks us just above median. Keep in mind, per John's comments, when we look at our equity exposure, when we look at what we had exposure to versus what was under pressure in the market, that certainly was the explanation. One of the explanations for how well we've done in the past also influenced us in the opposite direction in the quarter. For the fiscal year to date through March, a return of almost 3% ahead of our benchmark meaningfully and in the top third of other plan sponsors. And when you look at the longer picture, we're ranking around that third to even in the 16th and 10th percentile for 7 and 10 years. So you continue to do extremely well versus other plans, and compared to the benchmark that you've chosen, which resembles how you are structured from an asset allocation perspective, doing quite well. Now, I generally don't spend this much time in this section, but I would like to have you turn to page 11, which is the capital markets review. It's got a lot of words and a lot of pictures on it as well and numbers, but I wanted to call your attention to a few of these pages that we rarely go through because I think they have some interesting observations that we can make very quickly. One is, if you like a picture better than some of the numbers as just an indication of what's happened to interest rates, look at the bottom right-hand corner and look at where the light green line is. That is the yield curve as of the end of March.
Becky, you gave me a page number, but I'm not sure where you're at. Oh, okay.
Yeah, past, there's kind of a divider after
Oh,
all the
okay.
written material. There you go.
Get me in the wrong section.
So interest rates, again, really steepened and increased relative to where they've been in the past few quarters. Certainly relative to 2019, the short end of the curve is well below where interest rates were at that point, but you'll see how flat that yield curve was in 2019. At the top of this page, the unemployment rate, look how low that is relative to history going back to 1948. Again, just supporting that hot job market we're in right now. CPI is towards the top quartile of what we've experienced since 1914. US government debt, this really hasn't moved all that much, but I keep pointing it out because it is a risk factor. Just look at where we are from a US debt as a percentage of GDP measure going back to 1940. Now, obviously, the Fed is going to be actively working to reduce their balance sheet. That's part of most of the announcements that they have made as to what their plans are. VIX is volatility. We've seen periods where it's been in that top quartile. It hasn't been there as of this period of time, and consumer confidence still remains pretty healthy. If you look at page 12, the only thing I'd like to call your attention to is two things. One is the bottom left-hand section of page 12. Just look at where those blue diamonds are. And this is after a little bit of correction in the equity markets. US equities still remain expensive. And of course, a little less expensive when we pass the end of March. And the other thing that may be a little surprising is when you look in the bottom right-hand corner, the dark blue bars show you the return for the quarter. The light blues show you the return for the year. It's kind of been subtle that the best performing sector over the last year has been energy. We're so used to seeing technology or consumer services or consumer discretionary, other sectors other than energy, but energy has certainly stood out here again because of the price of oil that you've seen, again, influenced by what's going on in Russia and Ukraine. The next page, let's look at two things again. Bottom left, international equity, look at where those valuations are relative to history, fairly low. Certainly not in, they're becoming a little cheaper rather if you factor in performance since the end of March. On the right-hand side in the bottom right-hand corner, who would have thought that Canada would be the star of the show when you look at performance of various regions, stock markets? And again, that's because of natural resources and energy. Same answer as the page before. And some of the most under pressure has been emerging markets. And not all of that is Russia and Ukraine. They were very tiny pieces of that index. It's really investors selling off, if you will, risk assets when they're afraid and there's uncertainty around. On page 14, there weren't a lot of places to hide in fixed income. One thing to show you, upper right-hand corner, the same blue bars and dark blue bars and light blue bars showing the quarter and then the 1 year. There really weren't a lot of places to hide. Tips, if you look at the last year, Treasury inflation protected securities, good performance for the 1 year. And then bank loans that really don't have any duration exposure. They're just credit investments. They were, for the last year, had positive performance and basically flat, down 10 basis points during the quarter. And everything else on page 15, if you look at the bottom right-hand corner, we show you a couple different snapshots of real estate for the quarter. The Odyssey, which is core real estate, Increase is broader, returns of 7% and 5% in the quarter. So real estate has been a safe, not a safe haven for value because it can be impacted, obviously, but it's been a good performance during this period and is a real asset. REITs are securitized real estate. This is something that tends to behave like the equity markets, especially in periods of stress, so down for the quarter. Commodities, we've talked about that, and natural resources, you can see how good that performance has been. And then finally, the TIPS market. So I just wanted to give you a little bit more context than we normally do on valuation of stocks, where we are with bonds. And then finally, the quilt chart on page 16. We normally don't go through this either, but it is a great exercise in humility to think that we can say, okay, it's going to be light green this year that's going to outperform everything else. Light green being small cap US stocks. It does change a lot, and it's been a while since commodities were the best performing. And when you look at the right-hand side of this page, the year-to-date picture shows you a return of 25.6%. And the next best performing asset class is real estate, and then it's cash. So that's pretty sobering when everything else has a negative in front of it. Going down to long duration fixed income. So corporate pension plans that have immunized their liabilities by buying long corporates are having to just not look at performance and realize that they did that because of the structure of their liabilities and the valuation of them. And they certainly aren't there for a return. And this has been painful for boards to just realize why they made that decision. So with that, getting to the specifics on section 2 is your performance. We start with a little self-praise about the Greenwich Quality Award. That's just something we wanted to let you know. It's our 5th time at being named one of 3 large consultants who received this award. And it's based on a number of criteria based on client interviews. So we're really pleased to be able to announce that we were able to get this recognition again. Let's move to page 5 of your report. This is just showing you the retirement plans in combination, $14.6 billion. PERS is 7.2 billion and teachers retirement 5.1. If we look at the following page, you can see the retirement plans specifically and their allocation. By segment, you can see how much is allocated to cap and short term. Per usual, we show you that detail, and then we get into performance on page 7 for the total fund. So I did show you that page in section 1 that showed this performance, but this is showing you PERS at the top, TRS, and we show both net and gross. So we show you gross so we can show you rank, and you saw this detail in the previous page. Good solid rankings relative to peers. And if we look at your net of fees performance compared to your benchmark, which is at the top, you can see for fiscal year to date, all the way out through 7 years, outperforming 10 years, just 17 basis points below, and in the quarter, 37 basis points below. And again, because we do have private assets and there's difficulty in benchmarking that, as we talk about in every quarter, you don't put a lot of concentration or analysis into what's going on in one quarter, but the trend really has been you've been successful in beating your benchmark. If you look at page 10 now, and I'll start picking up speed. Please slow me down if I do go too quickly. But on page 10, this is a comparison of your structure at the bottom of the page versus the population of public plans that are greater than 5 billion. So this shows you, and per John's comments about your equity exposure, that gray bar on the left-hand side shows you US equity and the range of allocations among plans, and it's about 51 other public funds that are greater than 5 billion. You have 31%, which puts you not top in quite in the top quartile, but pretty close to it in terms of US equity exposure. And non-US equity here labeled as global ex-US in the 38th percentile. So you've had this equity component in your structure. It's been very helpful in the long term in adding to returns. Equity just happens to be the primary source of volatility in any investor's portfolio, and yours specifically as well. And so when you have a down period, that certainly is something that's not surprising. What has been more surprising is just how quickly the US fixed income markets have corrected, and you have an average allocation to fixed income in the 53rd percentile where you look at that green diamond. Alternatives, you have an allocation that is below median in the 71st percentile. What's a little different about your structure is others also have private equity programs, but they have hedge funds and other types of products that are in that alternatives bucket. It happens to be that private equity has been one of the best performing strategies in this entire large bucket. And so that has been accretive to your performance. And then real estate, as I already mentioned in the market commentary, having a higher than median allocation to real estate has been very helpful. You are in the top quartile of exposure to real estate. And again, you can see the median is at 7.7. So you have this real asset anchor in inflationary times, because inflation can be passed through in some cases to lease payments. So that is certainly helpful. And in this case, it's been accretive to your performance. So let's look at page 12, looking at risk return over various periods of time. That's very important. It's not just the return you're earning, but what kind of volatility are you experiencing? And on this page, in the upper left-hand section of the page is the graph. The gray boxes are other peers in that public fund peer universe greater than 5 billion. You can see the hash mark, that's the median peer plan. And the median peer plan had a return over the last 5 years of 10.1% with a standard deviation of 8. You had a return of 10.5 with a standard deviation 1 basis point less. So that is a terrific result. We like anything that is leaning towards that northwest quadrant for sure. When you look at your benchmark, you're aware that there are some elements of benchmarking your portfolio that are capturing public markets in order to benchmark private in the case of private equity, for example. And that's adding, if you have small cap and using that for your benchmark, there was a lot of volatility in small cap, obviously. So benchmarking issues are really what's driving the blue mark being way over on the right-hand side, having more volatility. But again, when we look at your actual return and risk numbers, they're rock solid over this 5-year period, and compared to other plans, you've gotten a little bit more return for about the same risk. Let's look at a 10-year period of time on the next page, page 13. Very similar result. Here, the difference between you and your benchmark is the same, although the benchmark now having a little better return, but compared to other public plans for the same level of risk, you've added additional return, which we certainly do like. I will have you turn to page 14, just for a quick snapshot of the cap and short and the trust fund pool, $2.8 million in terms of the trust fund pool, and when to have you see that result. And from there, we will look at page 16. This is looking at the cap. And again, because the cap is the largest holding in your retirement plans, I won't go through the specific performance of the cap, but I will show you the asset allocation on page 16. You can see its allocation. If you were to add together the traditional equities, domestic equity and international, you can see that's about 49% of your portfolio. Fixed income, combining core and non-core fixed income, is about 20%. Real estate's about 11%. And then you have your private investments at 15%, and then cash.
And again, that real asset allocation of 15, definitely an advantage in an inflationary period. Now, if you look at the asset class performance on page 17, you can see what those returns look like. And this can be the last page that I go through unless you have additional comments or want additional depth. But when you look at domestic equity, given some of the numbers that I gave you and in the market observations, it's probably not surprising that there is a loss a little bit more than 5% as we look at the quarter on a fiscal year to date. In positive territory, again, we've fallen further as we look at the past the end of March. International equities fell a little bit more during this period and are in negative territory for the fiscal year. Core fixed income, again, in this unique environment where we have this repricing of fixed income in a rising rate environment, a negative 5.3% for the quarter and fiscal year to date. Non-core fixed income, a little less loss there when we look at the combination of high yield and emerging market debt and other sectors. You can see that provided a negative return in the fiscal year and quarter. Real assets, that's positive, that's black type of 5.9% rate of return in the quarter and 10.5 for the fiscal year to date. Real estate, you can see also positive, strong fiscal year. And in fact, last year was the strongest year for traditional real estate in the history of the benchmark itself. So it's awfully nice to see. And then finally, cash yielding a whopping couple of basis points, and your private investments returns are at the bottom. Again, your custom index that I mentioned was one of the differences here, showing a negative return versus strongly positive. Now, do we think the private investments are going to be insulated from this fall in equities? If you look at private equity, no, it will happen. It will just take more time for those investments to adjust. But not all of your private investments are private equity. And so, investments in private credit and other things will be a little different where they're more yield oriented. So again, not fully baked into these numbers for March.
Missy, could you go back to page 13?
Absolutely.
And on the bottom, comparing like the Sharpe ratio and those things to other plans. Is there any takeaways we should get from that information? It's a long period of time and compare us to others.
Yes, I'm glad you brought this up, and I'm glad you aren't tired of hearing my voice already and want a little bit more detail. But I will go through this. In fact, standard deviation, we'll start with that one. That's just risk, how much returns move around. You have about an average level of standard deviation. You rank in the 48th percentile. And if you look at where that green diamond is versus the range of other plans, you can see that you are right in the middle. And it will vary significantly based on asset allocation. And so that's not a surprising result. It's a good thing if you think about the fact that you do have more equity in general than other plans, more marketable equity, as I showed in the earlier peer group charts. Your other diversification has helped you have a standard deviation or risk that looks like median, even though you have more in that volatile asset class. Sharpe ratio is excess return per unit of risk. This is a great result. This is versus the risk-free rate compared to other plans. You rank in the 15th percentile, so you're managing risk well. Excess returns, you've done well there. Downside risk is probably a really good one to focus on. So this is measuring how much you are moving when the market is moving down. How much are you participating in that? So it's only taking the negative movements of the market. And your number is smaller than your peers, which is a good thing. Just slightly though, about 4.18 versus 421. The real difference is compared to your benchmark. You're significantly better off than what your benchmark has experienced during these periods. One thing you should keep in mind is how much equity sensitivity do you have in your portfolio that's measured by beta in this case, in this particular evaluation. And you do have an equity beta that's higher than other plans. And so in the 31st percentile means that your plan moves around more, is more impacted by what's going on in the equity markets because you have a higher allocation. So that's something to keep in mind. This is one of the reasons we love having real estate in your portfolio, because it tends to move very differently than the equity market. And at this point, real estate continues to hold up. But, we do need to keep in mind that it is possible, if the interest rate environment continues to get more difficult, if that actually starts impacting folks as they think about the real estate decision, it could impact them. But this is a very different environment than the global financial crisis, at least so far. And in an inflationary period, again, real estate has done well. So hopefully that helps a little bit.
Yeah, I like that. Thank you.
You're welcome.
Can you talk to that downside risk again for me?
Sure, it's actually measuring the downside movements of the market. And so if you had a number in that downside risk that was very high, that means that you are negatively impacted more than other plans when the markets go down. And the fact that you have a median result, even though you have more equity exposure, is a nice result.
Other questions? I don't want Jim to nap up there, so Jim, broad question, but what would you add to this discussion?
Well, the quick answer is nothing. But since you put me on the spot, it is, if we step back and look at this, one of the interesting things about market history is since the intervention of the Fed in a very deep way into the investment markets, beginning with Greenspan back in the tech telecom bubble and then the bursting of it, we're seeing more historical events occur on the upside and on the downside. This first 5 months of 2022 is yet another example of how extreme the movements of the market have become, in the sense that there has not been a period like this where both bonds and stocks have declined in tandem at this pace and to this amount. Quite frankly, when we published our capital market assumptions that we went over with the board, which were, we characterized them as cautionary, we really didn't expect there to be a quick reaction by the markets to move more toward normality. And as Becky said about equity, they're still expensive. They have not moved all the way toward where we think they might end up, but they have started that process for sure. The other thing that I would mention is that looking forward, I saw the CBO report that she mentioned as well, and I don't want to characterize it as rosy, but as she said, it's surprisingly upbeat, because there are many other voices in the market and studies that are warning us that there may actually be a recession. And I noticed an analysis this morning as I was reading my research that in market history, when the Fed has been battling inflation and the economy has slowed down at the same time, those have been particularly challenging episodes, because the Fed has not been able to come to the rescue of the market as it did in 2001 and 2 to rescue the equity market from the tech telecom bust, as it did in 2009, 10, and 11 and onward, when it rescued the capital markets from the GFC, and in 2020 and 21, when it rescued the markets from COVID. If the Fed has its hands full fighting inflation, if there is any economic weakness, it won't be in a position to perform what the market participants have seen as in the last couple of decades as the rescue mission. But so we remain cautious, but I would just echo what Becky said. You have been able to pull off a growth-oriented fund with a noticeable equity exposure, but you have sufficient diversifiers that it has not led to any indication that you're courting unusual risk. So that's the comments I would make, and I'm going to stop there without even a single analogy.
I was gonna point that out. There was not one.
I think it might be just Carl encourages that.
Can I have a follow-up? Yes.
Go ahead, Mark.
So Jim, 2001 and 2000, the Great Recession, when the feds took action there, was inflationary, was it inflation as high as it's been in this go around?
No, and that's exactly my point, is that they didn't have to fight inflation back then
So now they
because
gotta fight inflation as it does.
now they have an inflation fight on their hands, which is forcing them to raise interest rates. So any weakness in either risk assets that investors would like them to counter, or in the economy that all of us would like them to counter with monetary policy, they would have to abandon their fight against inflation to do so. And so they're going to earn their money over the next 12 to 24 months.
Well, if they
So
get it right.
If they get it right.
Well, the argument in the marketplace and in the institutional investment marketplace is whether or not they'll pull off what's called a soft landing. That is, they won't have to send the economy into recession, as is happened so often in the past during a monetary tightening period when they were raising rates, but at the same time be able to bring inflation down. The CBO report is a perfect example of an analysis that says they can do it, but that's not a settled issue in the marketplace for sure.
So, thanks, Mr. Chairman. Becky, Jim, it seems to me that follow-on comment there marks that we need to go back even farther, because the last time I recall the Fed having to fight inflation was 40-some years ago, 1979 and 80. So might there be some lessons from that experience, number one, and number two, did we see, because you're saying there's never been a period before where we've seen the bond market and the equity market go down at the same time. Did that happen at all during that period of time, or did they react in the opposite direction then?
They reacted in the same direction, but at different times and at different paces. The equity market fell first, and then the bond market fell because the Fed began to fight inflation. This was the Volcker Fed. I think the key takeaway per your question is that of the Volcker monetary tightening, the last time we fought inflation, and I'm old enough to have been an investor at the time, sadly, it was actually produced a recession in 80, 81. So, that this is why there's a debate going on right now, whether or not the Fed could actually curb this inflationary surge and not trigger a recession at the same time. Market history says that's a dicey proposition. The other thing I would say is that the media is full of inflation has peaked and it will go down. That would be a welcome thing. And by the way, our capital market assumptions assume that over the next several years that will happen, whether it happens because of a soft landing or a recession does the job on inflation. That's to be determined. But keep in mind that once inflation has been experienced, it doesn't go backwards. The fact of the matter is that we have negative real interest rates, and we have negative real wage growth. And even if inflation stops getting worse, that damage is done and has to be essentially repaired through either increases in wages over time or adaptations to higher energy costs or whatever the case may be. So it would be a welcome event if inflation went down, but the damage that the surge has caused still lingers on. So I'll stop there.
Other questions? Go ahead.
Two.
given that the pension boards have reduced their rate of return assumptions, I guess I would like a review of the difference in time horizons between your RBK's capital market assumptions and the rate of return assumptions that are set by the board. And then add on to that, and I don't know who should answer this, how our reduction in cash influences, and because we'll get this question, I know you will in your board meetings, the cash flow in order to pay pensions. Anyone who can answer those?
So I guess the
Well,
cash
well,
flow-
let me say with respect to the differences between a capital market assumption and an assumed rate of return, there's two things that are different. One, well, three things actually. One is the horizon. And we can detail that in a presentation to the board at a future meeting. Ours is long, but not nearly as long as most actuaries. Theirs is much longer. The second thing is purpose. Purpose number one, and purpose number one is to set what would be considered by the actuary appropriate contributions. Purpose number two is appropriate contributions in the context of spreading the cost of public services over generations of taxpayers equally, intergenerational equity. These are not things that figure at all in capital market assumptions. So there are differences in horizon, but there are other differences as well, and we'd be happy to detail those. I'll stop there.
And so I think the important thing, these numbers are net of that, pension payment conversation. A few years ago, we had the joys of net cash need being introduced to the legislature and the pension boards, which was new and I think scary. Had dinner with someone last night and they said, you people are terrible at marketing. You talk about an unfunded liability. You bought a house, you got 73% of the house paid for, and you're all focused on the little bit that's left. Like, okay. So, the component that's important for us is these are net of return, these are net of those cash flows. We get about, I want to say half, between a third and a half of benefit payments in contributions on a monthly basis as well. So it's not like it's all one direction.
So I guess I'd add to that, Diane. I mean, in the first slide that you see in our investment presentation addresses what that net cash need has been and how much we've earned over the long periods of time and a little bit, but obviously additive, in the short run, something we're always thinking about. I mean, I'm currently, to Jim and Becky's points of bonds and equities going down at the same time. It's like, well, okay, how do I rebalance things currently? That's probably a greater challenge the last quarter or so than it has been in last year, at least anyways. But we have a diversified portfolio in many places that we can tap to make sure. I have no concerns that we can meet our net cash need for a significant period of time here going forward. It really comes down to choices about, well, do I want to sell equities which have fallen a lot and could fall further, or do I want to sell, bonds or commodity type things perhaps that have gone up? Where do you draw some of that from? But the good news is, generally speaking, with our portfolio, there's also a lot of places that are just spinning off cash, be it real estate or bonds or whatever. And so, and in fact, some of the private investments, as we've talked about in prior quarters, have been returning a lot of capital recently because it had been a good environment. So to the extent we have those kinds of cash flows coming in, we're in pretty good shape to handle that net cash need on a regular basis that we know comes up.
We run that analysis every year. Aaron puts together, what are we just going to get on coupon payments and in addition to the contributions? So we can get a better lens on what those cash flows look like. I think it's and John, not to put you on the spot, but it's fairly safe to say we're not forced sellers at inopportune times, right?
Yes.
You know, I would put a big point on what John and Dan just said. We've done so many liquidity stress tests on pension plans and other types of plans as well. It is extremely rare. A plan has to be severely underfunded to have a short-term liquidity problem in the sense of not being able to pay benefits. And this plan is nowhere in the zip code, in several zip codes of even concern about that. And yet that happens to be the first fear that constituencies often sort of voice, and it is rarely on point. As Dan noted, the real issue on liquidity stress test is whether or not you have to do something to make sure to provide all those liquidity demands that somehow impinges on possible investment returns 5 years or 10 years or 15 years out. That's the risk. Not the risk is not being able to pay benefits. That's a given. I'll stop there.
Well, Becky, I think you and Jim have warned this board that we may face some down markets, unlike we've seen in the last few years. On a general board, high level advice, how would you tell us to manage these down markets, even if it's for a while, from a board level?
I think one of the biggest pieces of advice that we give to clients, especially if they're in a good cash flow position where they're able to provide for their primary purpose, which is making benefit, is if your asset allocation has been chosen for the long term and if it's constructive to the long-term needs, then as John said, your opportunity is to rebalance. And one of the best things the board can do is to stick to that regimen, because boards, when they become afraid and feel that this time it's different, we must do something drastic. That is such a risky proposition because they're making a short-term observation, coming to a short-term conclusion that the plan may not ever recover from. And it's just something that, as a fiduciary, matching your decision-making to be consistent with the time frame of the fund is incredibly important. And taking these market events in stride and knowing that evidence actually shows us that rebalancing to your target is one of the best things you can do for this fund. And the exceptions to that are if you have some kind of unforeseen call on liquidity that isn't being anticipated at all, or if your time frame changes, and we're not getting any of those indications at all. So rebalance, rebalance, rebalance is our message.
One of the things I think this board has done well is we're always looking to improve.
Mhm.
And you who know us very well, what if, just a broad question, processes or other things, is there some things the board should be looking at that would improve what we're doing here based on what you see from others and your opinion?
I think the board has, one of the decisions the board made years ago has been incredibly helpful in allowing the board to spend time on the things that they should be, which is decision-making, consideration of asset allocation, and then monitoring the decisions that are being made. Delegating the manager decision to your staff is one of the biggest time savers and division of labor that some plans are still struggling with at this point. So they end up being concerned about the equity holdings of one of their 50 equity managers and whether to approve them as a manager or keep them when they don't have the benefit of the context of the portfolio and the time to spend in monitoring. So you can't improve on that except to keep it up and to keep monitoring it, because that is your obligation as a fiduciary, is to make sure it continues to work. And so asking questions of your staff, asking questions of us is where that duty comes to fruition. Regularly having asset allocation studies to make sure that this aircraft carrier is pointed at the right target is absolutely important. In terms of improvement, I think one of the things that some boards label as an improvement is some of these social issues that were talked about at the beginning of our discussion. It has led to a lot of conversations away from primary job number one, which is making sure that you are delivering benefit payments to the beneficiaries. You've had a laser focus on that, and a lot of plans have been struggling with some of the issues of what to do with the pressures that are out there in the marketplace right now. Should we constrain our investment policy? Should we align it to a new set of values? Should we do this? Should we do that? At the end of the day, as fiduciaries, as you always have done, keeping your eye on that ball and not getting distracted from it is incredibly important. Improvements, I think you'll just find along the way. You may decide you want more or less focus on an asset class each time. One of the improvements I think you did that helps in the delegation and understanding of that delegation is I love the deep dive that your staff does on an asset class or a system, and they show that to you. That is ongoing education on what your staff is doing. That has been a big improvement, and I would suggest keep it up, because I think the more you understand what your staff is doing, the better job you can do as fiduciaries. And then finally, it's almost to the point where you can't get enough good education, but your commitment to education has been very important. And looking for ways to keep that education fresh and in front of you, I think is one of the things you can constantly do to improve.
Yeah, I would just say that, when you often ask us this question, and we often tell you that we sit in literally hundreds of boardroom meetings, and we would tell you if we didn't think that this was not a first-class operation. It is, for all the reasons Becky said. I think that the two most important, and I would say that the improvements don't always come from big board votes. They often come from questions that the board asks of your staff because of your delegation model. And so the two most important meetings or events that spur those questions and spur improvements that maybe don't have the board's voting footprint on them or fingerprint on them, but are nonetheless improvements. And you've seen many of them, like the diversification within the fixed income asset class, come from asset allocation meetings and deep discussions about that. And each of those deep dives you do with respect to each of your major asset classes. So sometimes the improvements, particularly when you're doing as well as you are, aren't great big changes. They're continuing to ask questions in the best venues and having the organization, your program, respond to them. And I think that's where the opportunities lie. So I'll stop there.
Anything else while we've got these guys here so we can get our money's worth?
I'll stick around so you can keep getting your money's worth.
Okay, so I think we're done with that section. We're going to have a break now. What do you think, Dan?
15, come back 5 of.
5-2. All right. I'll call the meeting back to order. And so John only made one board member leave, but anticipating his presentation.
He'll make more people mad.
And so with that introduction, John, it's all yours.
All right, thank you, Mr. Chairman. Go behind tab 5. So investment updates on slide 4. So we were talking about it earlier, net cash needs slide. So 1 year, 5 year, 10 year timeframes here. Our chart on the left-hand side of each of those is where we started the period at, dollar value that was added over time through the investments, then the net cash need subtracts what we need to pay out for benefits and where we ended. And so you can see over all these timeframes, we have more than met the net cash need, but in particular, drawing attention to the 5 and 10 year timeframes, as those are, as always, the most important. Turning to slide 5. So over the course of the year, the net cash flows that we've had within the various asset classes, look at that second column from the right, you can see that as we've needed cash to pay benefits and things over the course of this year, the majority of that has come from domestic equities, the sale of domestic equities. That was generally probably in the first 9 months of this 1 year period, and then private investments, as we've mentioned, last several quarters have been particularly active in returning capital in recent quarters, and so that has also provided a lot of the cash that we may have required, and then kind of small adjustments in the other categories there. Any questions on any of that?
John?
Yeah.
So you use the cash equivalents obviously first, is that right? Is there an order that you use? it
I
in?
wouldn't say, it probably depends, Maggie, on, so as I think I've said before, you know, each month, obviously, we need to come up with benefit payments, so it's sort of the forced opportunity, if you will, to rebalance, because you probably have to take something from somewhere, although I say that, and there have been months where we got large distributions from somebody or another, and so cash positions were good, and we just paid it out of that and didn't need to take from anything potentially. So, you know, some of this obviously is just driven by, you know, changes in the market and things too, as things are going up and down, but
So that's what I was getting at. Is there like a discussion as, oh gosh, we're gonna need, you know,
I mean, there's certainly a discussion where I'm always looking at it really on a daily basis and thinking about, okay, are we going to need something? And Aaron and his team have put together a great spreadsheet that shows, you know, as things are coming into State Street. So we will know, let's say a couple weeks in advance that, you know, private investments is going to distribute capital, you know, on a given day. And so we'll see that 2 weeks in advance. So we're kind of gauging that as we go along as to what we, you know, may or may not need as we get towards the end of the month.
thank you.
All right, moving to slide 6. Just a different look at that essentially. And obviously the employees retirement and teacher retirement are the biggest 2 retirement plans that need that cash flow, and it's not equivalent through all of the plans here, where you've got firefighters as an example that's got a positive cash flow probably because they had greater contributions than what we saw maybe in some of the other plans, but that basic breakdown. Slide 7, overall long-term performance. So again, you know, if we're drawing your eye more towards the 5, 10, 20 year and since inception numbers, then always the big point here is that we're meeting our long-term return expectations. We're meeting our actuarial hurdle over time, and both our TRS and PRS representatives have noted, it's going down a little bit going forward. So slide 8, returns for all the individual asset classes. I covered this in depth, but no surprise here. Fixed income asset classes, higher rates have had a negative impact there. And then international equities, obviously the Russian invasion, and I would probably throw in the COVID lockdowns and things in Asia have certainly hurt international disproportionately, particularly the last 6 months or so. Slide 9, our midpoints here, pretty close to all the midpoints across the board. I guess I would only note here that we are probably straying a little bit further in the current quarter, and that is due to the fact that, as Becky pointed out, fixed income is dropping, public equity is dropping, so all of our public asset classes are dropping. And so rebalancing, it's not the easy choice of, well, I'll take from fixed income and rebalance back into equities. And so what's really happening is that we're going up in the range in the illiquid asset classes, private investments, real estate, in particular. And, you know, we're below more recently in the public sphere. And so trying to balance that, but in no way are we coming anywhere close to, you know, being outside the range or anything like that. So turning to slide 10, again, kind of just piggybacking on some of the stuff that you and Jim were talking about. So this is a chart that shows the PE ratios for both the domestic equity universe on the top portion and international on the bottom. So the black line is the PE ratio. The blue or the green colored line is the earnings per share. And so broadly speaking, PE ratios have been coming down, but as Becky was noting, you know, domestic equity in particular, it's sort of back to fair value. And this has dropped, and this was May 6th. That's actually dropped a bit more here. So it's probably close to 17 at this point. So I'd say it's sort of getting right around that long-term fair value, but in no way is it as cheap as what we would have seen, you know, in some of the prior periods. So certainly things could continue to fall. I'm not saying that they will or they won't, but it's certainly a possibility. I wouldn't say that we've necessarily, you know, hit what would have traditionally been rock bottom in some periods of time. International, a little bit cheaper and a little bit cheaper yet here more recently. So maybe they're closer to a bottom, but I think in a lot of ways, as you all follow the news cycle, probably cheap for a reason in a lot of instances as well. Earnings per share, again, as kind of Jim and Becky mentioned, they've been strong. I think broadly speaking, the economy is doing reasonably well. I mean, we're kind of coming out of some tough comps in some ways. I think we've more seen a rotation from people buying goods while they were sitting at home and having them shipped to their house to people moving towards more service-oriented stuff. And so what they're spending their money on may have shifted, but broadly, I think the consumer in the US has remained pretty strong. But should the Fed raise rates enough and roll things over, those EPS estimates for companies could start to dip as well, and then somewhat of a self-fulfilling prophecy at that point. So a lot of uncertainty out there, I guess, is maybe the bottom line at the end of the day. Slide 11. Again, we talked a little bit about inflation already, but an illustration of inflation through time. So you look over at the far right, those are the recent inflationary numbers. You can see that we are at levels. If you look over towards the left, you got to go back into the 70s before you see the types of inflation numbers that we've seen here recently. So clearly a big concern. If you turn to slide 12, again, talked about interest rates, but yes, they have jumped substantially. The market is estimating at this point, you know, kind of 7 to 8 more hikes before the end of the year, so that we would be somewhere around 2.5 to 2.75% on the short end. You're all familiar with having a 0% return in your savings account over the last many years, so that might actually turn around here at some point. And obviously, rates, the significant driver in bond returns. Rates rise and bond prices fall. So, but as I noted to State Fund earlier this week, I mean, the flip side of that as well. And I think maybe we're starting to see a little bit of that in fixed income as well. Rates go up, but that also gives us an opportunity to reinvest those bonds that mature at higher levels. And so that can be a good thing over the intermediate to long term, but a lot of short-term pain. Moving to slide 13, again, kind of speaks to the inflation story. Average hourly earnings are increasing at a very strong rate. That's the black line on top there, but they're losing ground to inflation. The blue line below it is, real average hourly earnings. So if you factor in inflation, they have less buying power at the end of the day. Even though they've gotten pretty substantial raises recently. So that also has an impact in the economy over the long term. And then finally, moving to slide 14, I actually showed this to you last board meeting. And I put current numbers in as of May 6th when we sent this board packet out. Down more like 17, maybe it's more like 16% today. I think we ended up a little bit, but we did touch a 20% downdraft in the market, S&P 500 intraday. I don't think we closed there on any given day, but about a week ago, less than a week ago, we closed down 20%, and 20% down in the S&P 500 is kind of, I don't know, a lot of people talk about it as the bear market number if you're down 20%. You can see that we've certainly been there many times in the past, and I think you'd look at all of the downdrafts here across the board and say, well, yeah, that was a painful period of time, however long it lasted, but ultimately, things do turn around and we end up going back up eventually. It's just a matter of how long do we have to wait for things to turn around.
I just didn't realize it's 123 days that we've been down. Oh, we haven't.
Well, we've had some up days, but it's been a downward trend. We haven't really broken that trend course of the year. As I tend to say here recently, it's like 3 down days and 1 up day and then 3 more down days. So. Okay, turning to slide 15. We probably beat it to death already, but lots of uncertainty out there. So creating a lot of challenges in the market, a lot of volatility in the market. Becky's advice earlier is sound, it's stay the course, stick with our asset allocation. We'll rebalance to our midpoints the best that we can. And I'm not concerned about us making our benefit payments at the end of the day. We'll get through it. Continually evaluating the asset classes and what we might want to change or put in there that's any different. But it's, largely stay the course, I guess. We've got marginally new things that we're always looking at, but I don't think there's anything earth-shattering in the pipeline at the moment. Certainly our in-person meetings and our due diligence are starting to pick back up, both from the standpoint of us going out and visiting people and getting back out there and seeing everybody, and we're starting to get the crush of people wanting to come back to see us in person, particularly as fly fishing season kicks off again. All of a sudden, it's very attractive to come to Montana, and they're just in the neighborhood and they're going to stop by. Great. So we can do that.
Do you contract with guides?
No, it's overrun and guides is a sore subject.
We'll try to focus them on different rivers if we
Yeah,
can.
keep me calm down.
We talked, about the people we've added and things here earlier, but fully staffed for the first time in a long time, so that's great. The big project here, I think, at the moment across the board has been Solovis and Solovis Risk. We've been making good progress there, so we have all the data loaded for the illiquid asset classes, private investments, real estates, real assets. And so we're working with that and starting to do some reporting there. I guess we have all the data is now loaded for the entire, or it will be June 1st.
In June, it should be.
Yeah, we'll have all the data for all of the portfolio loaded in June. June is kind of the test phase for that, making sure that's all clean. And then July 1st, we should be full go on Solovis. Doesn't mean that we're going to all know how to work every piece of it, but we're getting all that training and doing it now. And then Solovis Risk will fully come online over the course of that July to September quarter. It should be full go by kind of the 1st of September.
So what will that additional information will the board get on that?
So unknown a little bit at this point, I guess, as to, how much we'll bring. I think there will be hopefully some better reporting capabilities from Solovis that maybe we'll see some of the slides, particularly in the appendix, and things change. But probably a little bit TBD. On Solovis risk, I think there'll be some new things that we'll be able to more easily capture, such as, some of the stuff that like Becky's shown, standard deviation metrics, that type of thing, where we can look at those more broadly across the portfolio, and I think we can bring some of that as well.
Good.
I think that's it for me, unless you've got any other questions. Over to Karen.
Good afternoon. I'll just kind of quickly review these key takeaways. Feel free to jump in anytime. I'll reference the following 2 pages for the graphs. Jumping right into it, strategic asset allocation. Every benchmark, with the exception of international equity, core fixed income, and non-core fixed income, added positive contributions to the pension policy neutral 6% return. And as a reminder, I wanted everybody to know that this attribution analysis is done on a money weighted basis. So while, for example, domestic equities did not have the highest returning benchmark on an absolute basis, real estate did. Domestic equity benchmark contributed the most due to its size and its positive benchmark return.
But this is not non-weighted.
It is money weighted. It's money weighted.
Money weighted, okay.
Yeah.
Good.
Moving on to tactical. On average, we were slightly overweight domestic, international, and real estate. In aggregate, our overweighting, underweighting of the asset classes relative to their benchmarks increased the pension portfolio's return by 9 basis points, a small amount. As John mentioned earlier, we managed very closely to the midpoints, so we shouldn't see much in the way of tactical contributions. And the ones that do register are mostly just due to market fluctuations that occur between our different rebalances. This previous quarter could be a bit larger just because of the larger downturns, but we still rebalance very periodically. I don't have much to add outside of what is written for the style selection effects, other than maybe to note that within real estate, our exposure to commercial mortgage-backed security and REIT index, which are public indices, they're being compared versus a non-public benchmark. So we're going to see slightly larger contributions from those each year. Moving on to manager selection.
Why are we seeing a difference there? What's the reason?
So just like the private equity investments being lagged, their valuations being lagged, the same thing is done for the benchmark for real estate. And the underlying managers within real estate, Fidelity and Center Square are judged against public benchmarks. So this analysis captures how those benchmarks, those public benchmarks do against the asset classes private benchmark. So due to the lagged pricing of the public benchmark, there's going to be those deviations. So as I noted in the takeaways, we are now passive in domestic equity. There will be some small lingering effects from the managers terminated last November until we pass that date. Within international equity, one growth manager was the primary contributor to the underperformance. In core fixed income, our internal portfolio was the main contributor to the 9 basis points outperformance. The other thing I would note is this period is another good illustrator of how the lag in pricing of the private assets can create large effects during periods of stress. So as you can see, the private investments asset class contributed over 4% to the pensions overall 9.7 return for the year. Very large, and we'd expect to see that during periods of stress, with the opposite being true if there was a large rebound in the next year. That's all I have. If there's no questions, I will pass it on to Michael. Thank you.
Thank you.
Afternoon, everyone. I'm on page 19, private investments, market environment. First bullet point, deal flow was really strong in 2021, continues in Q1 of this year. I think we're watching closely to see what happens in Q2 and Q3. If what happens in public markets will trickle over into privates. So we're watching that closely. But deal activity and exit activity has been very strong. That's resulted in a lot of cash distributions and exits, and cash back to the pension. Valuations in the second point, looking at purchase price multiples, they're still at elevated numbers. We'll see if that comes down. There's a lot of dry powder, uninvested dollars raised in the market. And so it's possible that could remain elevated for quite some time, even though public valuations are coming down. Leverage is cheap and available, and so our managers are utilizing it. Fundraising has been very strong with the activity and investment and exits. We're seeing investment managers come back to market sooner rather than later. And so that, as a result of that, we're very focused on re-ups in our portfolio. Our managers are coming back to market sooner rather than have a historical 4 years. It's been more like 3 years. And so everything has condensed to move forward. Takeaways, this is really similar to what we've been saying the last couple quarters. I think the biggest thing is we're looking at valuations and the impact of public markets. Privates will move slower than publics. The swings will also be more modest because of the liquid nature. So we're watching to see how much that impacts the private portfolio. Some of the academic research I've seen is that privates will decrease 60% approximately of publics. I think that will be dampened in our portfolio because we have more private credit. We're pretty far down lower mid-market. And so we don't really look at a lot of the public comps, and the IPOs are less important. And so they focus more on discounted cash flow valuations and looking at the actual intrinsic value of these companies. But if we're at a 20% decline in public markets, a reasonable comp for privates as a whole, our portfolio would be down 12. And maybe that kind of range as far as expectations in the privates portfolio moving forward. We'll see if that happens or not. It might be fully absorbed. We'll see. So we're keeping an eye on that for Q2.
With the market doing what it's doing, how is your risk tolerance for deals? Does that vary what's happening in the public market, or does that affect anything that you look at?
Our risk mixture probably changes. I think in some ways I'm more risk on in these kind of markets, where if fundraising is down and we're in 10-year investment funds, maybe we should take more risk because there's not as much capital being raised and there will be a drought and valuations will be down. And so it's hard to really say because it's so far out because these investment terms are 10 years. And so, we changed the mixture of managers and exposures in the portfolio, and we don't really move as much on commitment sizing. We have a very measured and methodical pacing that we run, and that's been beneficial. And I can talk about that in the next couple of pages. But in some ways, I think our portfolio mix has changed. As an example, in private credit, we've taken a barbell approach, and that's paid off. And barbell approach being we focused on senior direct lending, top of the capital stack, first, last position. And so the equity gets wiped out, we get paid first. That portfolio has done, very well. And then on the flip side of that, we have added distressed credit exposure over the last couple of years. And that portfolio has done very well as well. And so, the bifurcation or between those two has produced a very nice private credit portfolio, especially when you're comparing it to the public comp and, high yield, which has been a negative return. And so I think on a risk adjusted basis, our private credit portfolio has done very well. And so in some ways, we've taken very little risk in senior direct lending, and we've taken a lot of risk in distressed credit. The combination of the two has produced a nice risk adjusted return. I'm on page 20. Absolute numbers look very good. Looking at relative to the benchmark, there's some noise here because I think if you break down the benchmark, it used to not include credit benchmark. It used to be purely equity, and we were essentially penalized for putting in private credit in the portfolio. So now it includes a private credit component. It also used to be an S&P 1500 plus 4%, which is quite a high benchmark. And for many reasons, we switched that benchmark. So performance has been strong on an absolute and relative basis. I think the big outlier to what I was speaking about earlier, if you look at the 5-year number, relative to the benchmark, privates has outperformed by 6.12%. A lot of that is driven by private credit and that spread. Private equity has done well over the last couple of years, but not as well because it's been a bull market, and public equity has done well, but our private credit portfolio has really outperformed that benchmark. Page 21. Market value of close to 2.2 billion. This number has actually increased. To John's point earlier, we're getting closer to 16.5% of the total portfolio. Even with the market coming down and the denominator effect, we still have quite a ways before we would hit the top of the band, which is 19%. So no real concerns as far as the liquidity in this portfolio. Very North American centric, focused on direct primary fund exposures. As I mentioned earlier, with kind of the fundraising environment, we're mainly focused on re-ups in our existing relationships. Cash flow profile has been very strong. Over 100 million has been returned in cash in the last quarter. If you go back for the last 12 months, this number is closer to 300 million. 291 million has been returned to the portfolio in cash. That's net cash. And that's, in contrast with us growing the privates portfolio. And so this portfolio is maturing and hitting a net cash flow positive profile. I am a bit reluctant to say it's net cash flow positive for the long term because it's been a great environment. But 10 of the last 12 months have been net cash flow positive. We'll see if that continues once, we see what happens with public markets and the effect that has on privates. But it's, a mature portfolio that's kicking off a lot of cash. 3 new commitments, Sumero, Veritas, which we've discussed previously in the previous board meetings, and a new commitment to Angeles Equity Partners 2 for 60 million. We can we'll discuss that later, or I can do it now, either or. Whatever is convenient.
Let's do it later.
Okay. That's all I have. Any questions?
So, Michael, I've asked this continually during COVID about due diligence and being able to get out and meet folks and have them come here to the extent they might want to come. How's that going? Better now?
Yeah, much better than, I would say, a year ago. Returning to normal. I think the spring is still up in the air. A lot of people are doing hybrid. And so for managers that are doing the annual meetings, there's a hybrid option available. We've been doing in person when there is the option to do that. And we are traveling and having managers visit, and so open door policy. So things are getting back to normal. It feels like in the fall, I would expect, absent any significant changes, that we're back to normal, inbound and outbound.
Thank you, Michael.
Thank you. Pass it off to you, Phil.
Hi, everyone. Mr. Chairman, members of the board, thanks for having me. I'm on page 22, and we're going to cover real estate. As normal, I'll just point you to the last bullet point, and we'll sort of talk about some of these key points here. You know, generally speaking, as of now, real estate still seems to be in a pretty coveted position relative to other asset classes. Fundamentals are in good shape. Fundraising continues to be strong. Dry powder is robust. While REITs have sort of been dragged down with the rest of the market, they are outperforming the broader market. Last year, we saw record volume in the real estate market, all-time record volume. We are off to the races again as of Q1. That is expected to moderate with rates going up and spreads widening. However, debt is still quite available, but rates are on the rise. Delinquencies are down, values are moderating. You know, so far so good, but keeping a cautious eye on the real estate market generally. I'm happy to answer any specific questions.
I always ask, what are the problems? So is there any specific areas of real estate that are more concerning to you than others?
I am very concerned with office long-term. I have been concerned with office since the lockdown. And particularly within our core funds. Core funds have quite a bit of office exposure in them, and the core funds did anywhere from, depending on the fund and their leverage profiles, 25 to 35% net returns as of 12/31, 2021 for the past year. And that is completely unheard of. So core is super fully valued, in my opinion. And there's a lot of office exposure within those funds. And nobody knows, and everybody's talking about office, and nobody knows what office is going to do. But I expect office will reinvent itself and values will adjust. There's already anecdotal evidence of people buying office and converting it to industrial, buying office and converting it to multifamily. That is my biggest concern. And even going into COVID, I didn't like office because it has higher operating capital expenditure associated with it, which translates into lower net operating income margins. It's more highly correlated to the economic business cycle and GDP. It's just generally more volatile as a property type. And so I have been purposely fading office as much as possible within the portfolio for the last number of years. Now, a lot of that's out of my control with some of these diversified value add funds that play across many different property types.
It's somewhat within my control because we can put in redemption requests in our core funds, which we've been doing. Primarily because we need to generate some liquidity here and there for rebalancing. There aren't any redemption queues. We're taking advantage of fully valued real estate prices, but I'm concerned about office.
Okay, so the opposite of that, what do you like then?
So really, this is going to sound like beating, a dead horse, but perhaps based on what you may have heard, but multifamily, industrial, data centers, life science, grocery anchored, infill retail, things that are really driven based on, basic human needs. People need to eat, people need to buy groceries, people need shelter, they need places to live, in addition to just major macroeconomic trends in the economy that are supporting supply and demand dynamics that are, I don't know what the right way to say this is, are overweighted towards continued positive momentum, rent growth, occupancy gains, et cetera. If that makes sense, if I answered your question.
Yes, thanks.
When you didn't have cold storage, he teed you up.
Well, that the spectrum of industrial is pretty wide. It goes from sort of 2 million square foot bomber boxes to last mile to, cold storage. We are working on a cold storage fund within the industrial logistics space. And so that's pretty exciting as well. Any more questions? Okay. We'll peel over to page 23, which covers performance. Touched on this a little bit. It's been very strong. A lot of drivers there, REITs, core. We've had a good run these last few years. Happy to answer any specific questions, but just let the numbers speak for themselves. I would certainly, I guess I would leave you with this. I would expect, as I mentioned in the key takeaways, I would expect returns to moderate, certainly. Core real estate just doesn't do 25-30% returns. I mean, it's frankly, it's been in a bull run since the GFC with the interest rate environment. And we've had since the GFC double-digit returns in core real estate for the last 13 years, which is unheard of. And that's going to end. There will be a mean reversion without a doubt. And I'm hyper conscious of that. And I'm trying to head that off at the pass as much as possible. But don't expect to see these types of returns going forward. Questions?
Sorry, we're measuring you against historic performance.
And that's my cross to bear. So thanks for the reminder.
John, 27.7 is the benchmark.
On page 24, we have the characteristics and activity. This is largely a repeat of what we've seen in the past. I will just draw your attention to the fourth bullet point around separate accounts. This has been here for a while. I'm happy to say that we have approved a couple of separate accounts. We are in the midst of legal here. This dream is coming to fruition. We're going to sign on the dotted line here probably within the next 30 or 45 days. And we'll have these and we'll begin the portfolio construction process and create these, meaningful vehicles and positions that have, will ultimately be constructed for long-term holds and cash flow. And so that's exciting. We are cash flow negative for the quarter. I wouldn't read into that too much. There were a lot of onesies and twosies. There were a couple of big capital calls, primarily from some funds that were paying down some debt. We did Angelo Gordon Realty Fund 11. We covered that at the April meeting. Total leverage across the portfolio is within constraints. I'm happy to answer any direct questions or indirect questions for that matter. Otherwise, we can just keep motoring along and we'll transition into real assets.
I would just say it's maybe worth repeating that Ethan's got a lot going on right now. So you'll probably see a lot of new commits that'll come in August and in that separate account space type stuff. And we're also kind of trying to pull back on core at the same time to fund a lot of that stuff. So, you know, it's a bit of a balancing act, but lots going on in this space at the moment.
So I was actually gonna ask a question on that bullet because I didn't understand. I mean, what does it mean, separate accounts?
Sure. The way I like to think about it is essentially, we are in a fund all by ourselves. And we've hired and we've entered into those separate account, or we will be entering into those separate account relationships with vertically integrated real estate managers who have construction and development expertise, acquisition and disposition, financing expertise, leasing, property asset management, all housed in their shop. And we will have more control. We will have lower fee structures, and we will have a very defined investment strategy, which is in our control. And we sort of develop in collaboration with the real estate manager themselves, with whom I've identified based on their areas of expertise. A couple of these separate accounts, just to give you a preview, one will focus on coastal infill industrial, where there's essentially no room to develop, and rents will likely probably go up in perpetuity because there's just no supply and everybody needs to be there. And then the other one will be on multifamily and industrial in a broader sense.
Sounds like a good thing. That's what I want to make sure I understood.
I certainly hope so. I certainly hope so.
That's the intent.
Yeah.
Just want to make sure I understood.
Quick question, are your rail cars in real estate or real assets?
Real assets.
Got a question when you get there.
Okay. Okay, let's skip along to real assets. I'm on page 25. And again, we'll just draw your eyes to the final bullet point. Oil is up, but I'd say the outlook is somewhat uncertain. I have my own views, but there's lockdowns, there's sanctions, there's supply and demand, there's capacity utilization within the refineries, that all of which are extremely tapped right now, which is largely why diesel and gas are as high as they are. Never mind the underlying, input there being oil, but it's a little bit uncertain. Production's up. The MLPs have been delivering. They're a good yield play. Construction was up last year. Prices were up with some of the basic inputs into the construction process. Timber and lumber remain elevated. The housing market is robust, notwithstanding the April number that I think I just saw today or yesterday, where existing home sales were down almost 17%. So that's interesting. People are pulling back from buying housing. A lot of that, I think is a function of interest rates, which is good for multifamily, even though, rents are up probably year over year, close to 15% and continue to rise. At least the outlook remains positive, but housing is something, to keep an eye on as a key indicator for just economic health generally in the consumer. And again, like most asset classes in the private space, there's a lot of dry powder available. There's a lot of money chasing a lot of assets, particularly in this quote, real assets and real estate space that has, arguably some inflation hedging characteristics, which a lot of pundits, will say this will support asset pricing going forward because there's just such a crush of capital that needs to be put to work, that are in these funds earning fees, and the managers need to earn their fees, so they need to put money to work. So, there's a lot going on in the market and just a lot to keep an eye out on, pardon me. Happy to answer any questions. Rail cars.
Well, I was going to ask
before, sure.
Fires first in timber. So I appreciate that we isn't our timberland on privately held, we don't have, so we're not dependent on federal fire lands, right? Federally held. So many fires going on, and I'm worried about whether we are in areas with our timber that are going to burn. But I'm assuming that a lot of ours are on much more managed growth that have not had the cycle of not being cut for too
Sure.
long and not have too much fuel and so
You
on.
bet. You bet.
Wasn't a very
So,
well-phrased question. That's part of the
so our timber is all held fee simple. We own them through our funds. I don't know to what extent, and they're all actively managed. So think about, they often refer to the term as pre-commercial thinning, which is a process by which they, and silviculture, which is a process through which they add herbicides and pesticides to keep all the weeds down, which is ultimately fuel. They will cut the smaller trees down that are not developing as quickly to keep spacing between the trees at a manageable level, which does help in some fire suppression, natural fire suppression efforts. Bear in mind that trees, as they grow, most of the trees that we own, particularly in the Pacific Northwest, they go through a natural pruning process. So as they grow, their lower branches will naturally fall off and the trunks will become elongated and the bark is arguably fire retardant. Recall that, many of these trees evolved actively with fire. And so they are biologically engineered to withstand fire, and on these actively managed lands, that is very much a key concern. I can get this answer super accurate for you, but in recent years, many of our managers have bought fire policies. And we have experienced fires on our lands. They have typically been the result of either, a fire, a lightning strike, or an accident on a neighbor's land. In one case, that was a St. Joe's timber deed, which we didn't actually own the land, but we owned the timber, and we ultimately got paid out as a result of that. I think we ultimately collected something like 20 million bucks. I could revisit that and get you exact numbers. That was probably 4 or 5 years ago at this point. But to the extent, I don't know, Terry, to the extent federal lands that have not been active participants in active federal fire suppression efforts border ours. But what I would say is, in my experience, irrespective of where our properties are located and who our neighbors are, fire is always a risk, irrespective of the management efforts as well.
It's increasing, so
I agree.
So I just am wondering about that asset class.
Yeah.
And then my second question was, how strong is the demand still for the rail cars? Remember in the Great Recession, you'd see miles and miles of cars lined up. And lately, as I've been driving around the state, I've started seeing that again. And it seems so odd with the supply chain, and I'm sure it's just unusual, but is the demand staying up?
I don't have a good answer for you, other than to share with you that we just had our first capital call for the ITE Rail Fund of almost 9 million bucks, where they purchased, I forget how many rail cars, but it was a fairly significant transaction for the overall fund. In my sense, just sort of thinking about that is, if overall demand was down and they were somewhat concerned, they probably would be managing their acquisition efforts. Certainly, they didn't need to get any more diversified than they already were, both from a type of rail car perspective, a lessor perspective, and a commodity perspective. I think they had almost 400 different types of lessors, almost 800 different types of commodities they were moving. So my guess is, because they made that acquisition, they feel pretty strongly about sort of the overall essential service aspect of moving goods and things around. But I would be happy to chat with them and get you a better answer.
It just surprised me, because at the time when it happened before, you look back and said, why didn't I think this was a problem? And I just was starting to notice it, but that was all.
Yeah.
If you'd make sure that none of them are parked along the Missouri for certain people, that would be great.
I'll put in the request.
Yeah.
Can you put that in the agreement?
It's too late. We already signed.
They were in our canyon for quite a while, but I haven't seen any lately.
I
parked
haven't either.
over.
This
I
was
haven't
on
either.
Missoula, Spokane in there.
Yeah, I'm just saying on our canyon from Durant to Fairmont to Ramsey, it used to have that one whole line was
And I
cars,
gotta
and I don't
think
see it.
that to Becky's point earlier about the strength in commodity prices,
Mhm.
it's probably supply chain bottleneck more than it is
Oh, that
that
makes
that
sense.
there's any
Okay.
reduction in.
Because a lot of them were oil,
But
I'm
but
curious.
that's just the guess on my part.
Yeah, okay, thank you.
So Ethan, back to your timber thing.
Sure,
I remember when I first came on the board, was there a hurricane or something and we lost much timber?
it
So
was.
did they have insurance on that? I mean, you made me think of that after you said that some of these managers had fire insurance.
They. Really testing my
Sorry.
mental
That was a
Rolodex
while
here,
ago,
Maggie. It
sorry.
was,
Seems like most of them are fire and bug.
yeah, I
right?
don't
That's what I
believe they
thought. I
had
didn't remember.
hurricane insurance on that. And there was a pretty substantial hit to that property. I'm not sure. I can get you more information. I just don't
There
recall.
was some
We made
salvage,
money on that.
some salvage.
There definitely was.
Salvage, but it was still a big loss, I
We had
remember.
we got an insurance payout on it.
That was because of a fire on a neighboring property that we experienced.
I was just
Caught fire and then the hurricane blew it down.
Yeah.
Oh, that
Which
was
one
the
was the
right
actual-
Great place to live.
Yeah, it was, I think it was called Mexicali, Florida, if I'm not mistaken. It was like ground zero for Hurricane Michael, was it? Yeah, I think.
One
So-
thing I might throw out there on the timber, as long as we're on it, and Stephen talked about it, was we're starting to get more incoming from the managers about selling greenhouse gases credits, essentially, environmental credits off of the timber land. So to the extent that they don't cut carbon credits, that's the word I was searching for. So kind of interesting that they're looking to monetize that as well. Some of the timberlands at this point. So
So if they don't-
another source of revenue, I
If
guess.
you don't cut, then the price of lumber just goes up more and more and more and more.
Any more questions? Okay, otherwise, we'll flip to page 26, where we see performance here. Again, very strong numbers there, certainly within the last year. A lot of that was oil, MLPs. Timber actually had a great year. Happy to address any questions. Otherwise, we can flip to page 27. Sure, Bruce. Oh,
yeah, I'll ask it in a minute.
okay. All righty, page 27 it is. So again, very, you see the individual portfolios broken out there within real assets. Again, it's North American centric. We've got growing international exposure given our recent infrastructure investments. Here too, we are looking to establish a separate account, and I'm happy to report that we are probably in the 8th inning of getting this one agreed to, and this, maybe to my earlier point, Jack, will be focused on digital infrastructure. So think data centers, fiber networks, and cell phone towers. With the growing demand for data and people keeping up with 5G and even 10G, I've heard anecdotally is coming, and people just consuming data at a parabolic rate. There's no end in sight here, at least as far as I can tell, or anything that I've read or we continue to look at new strategies, always looking to diversify, not necessarily looking to add strategies just because we don't have them. There needs to be a solid and sound business case, investment case there, but you can think of things like shipping or containers, for example, or even some more kind of core plus longer term holds in a diversified infrastructure portfolio.
What does that mean? You're just gonna get a bunch of calls after saying that?
I am, yes. In fact, they're already coming because this hit the wire, I don't know how many days ago, but they started rolling in about 4 days ago. So yes, that is an externality of these presentations, but it's also my job because you just never know. I'm happy to get inbound and happy to talk to new managers about whatever they're pitching because without deal flow, we don't have a business. And so just par for the course. No new commitments. Our timber portfolio leverage is listed there. That's well within our 0 to 30% constraint. Happy to answer any questions.
Yeah, following on that, same question as I asked Michael. Due diligence easier, better, more comfortable with it now?
You know, from my perspective, Bruce, nothing really changed. You know, I know there were some folks that, you know, everyone sort of looked internally and didn't travel and so forth. Our process never changed. I don't feel like I ever had to pivot, change things up, you know, during the darkest of the dark days. You know, John and I went to LA and it was a ghost town, but we met with a manager because it was a new manager. I went to Copenhagen, Denmark. I took another trip, I forget where it was, maybe to Chicago. But to your point, yeah, I think things are probably easier, maybe from their perspective, because we're wide open and they've relaxed their constraints and restraints, and they want to come see us, and they're definitely more open to us seeing them. But, you know, from my own personal perspective, nothing was difficult. Nothing really changed. Well, things changed, but it was sort of steady as she goes.
You were comfortable, you got the job done even under those circumstances.
Absolutely, without having to really do anything differently.
Yeah, but we've ramped up. We've traveled more in the last
So,
6 months, probably. than
I've
we have in
been
the last.
on a hamster wheel, and I'm the first to admit that it is all self-inflicted. I had built up a very significant pipeline of high conviction opportunities the pig is just exiting the python now. And I'm sort of taking a deep breath.
That's quite an analogy.
Close to dinner time.
Anyway, the backlog is getting worked through, and I'm just it feels good. It's a relief, and then we'll wrap up a few things in the coming 30 to 45 days, and then we'll really focus on just data monitoring. I'm going to take a fresh look, and probably Thomas and I are going to restructure our overall reporting. Just given Solovis coming on board and just taking a whole fresh look at that, and really just getting everything ship shape and super tidy, and right where we want it as, you know, the world sort of awakens and, you know, enters a new paradigm of.
We're gonna be busy in August.
Yeah, I'll probably give you 4 different new commitments deliveries, yes, 5 actually.
June is a huge month for travel for us. Strategic reasons for that, timing reason, just normal course of business. So, you know, we'll have to talk about that special board meeting because many people are out of the office for a good 2 weeks, if not one. Just doing exactly that.
Yeah, sure. Any other questions?
Not, thank you.
All right, great, thank you.
Uh-oh.
Well, not exactly the welcome I was hoping for. You're gonna drag this out now, Jim.
Yeah, you get revenge, I know you do.
Pythons get our.
No. Turning please to page 28, core fixed income environment. I kind of feel like anything that can be said about the fixed income environment has been said. So I won't go into this in detail other than a few things that I'll call out. As we know, the yields went up fairly significantly, went up dramatically, I should say, for fixed income. That happened largely in the front end of the curve, where we saw, you know, even up to the 5-year go out a little more than 150 basis points. But the 30-year, for instance, barely changed at all. So a little bit of a flattener from the belly on out. Other thing I would call out is money market yields have increased significantly, and why that's important to us. Well, STIP's a huge portfolio, 7 billion-ish now, and so distributions from STIP will increase dramatically over the next several years. So in case, we're going to go from something in the neighborhood of 25 million to something in the neighborhood of 140, 150 million distributions out of STIP over the next couple of years. So that might show up in headlines. Going on to page 30, you can see the return for the core fixed income was a lamentable negative 3.6% over the year. Both the internal portfolio and Reams outperformed their index. Reams outperformed by 83 basis points due to being short duration or less exposed to interest rate risk. The internal portfolio outperformed because by 55 basis points, we were short duration also, and we were light corporate credits, which widened a little bit on the year. At the end of the quarter, the duration of the core portfolio was about 91% of the benchmark, since has gone up somewhat. And the portfolio maintained an underweight to spread product and an overweight to treasuries and agencies. Any questions on the core portfolio? None. I will get out of Jason's way.
Thank you.
Didn't drag it out.
Yeah, the threat was empty.
In deference to the other board.
He's coming back. So. Good afternoon, members of the board. You've heard enough about the environment, which has been challenging. So I'll focus more on how it's impacted our asset classes. First with non-core fixed income here on page 32. So we had a reaction to all these pressures in the market with rising bond yields, and it had some interesting effects. First, you've heard the interesting, or the anomaly was they had both bonds and stocks selling up the same quarter, but there was more within non-core fixed income. High yield bonds outperformed investment grade bonds, and lower quality bonds within high yield outperformed higher quality bonds. So how does that happen? And the answer is duration, interest rate risk. US high yield bonds have shorter duration than investment grade bonds do, and lower quality bonds typically have shorter duration than higher quality bonds do. And that really was the determinant of returns for the asset class in the quarter. That affected preferreds. Preferreds typically have longer duration than do high yield bonds, and you went on to emerging market debt, which also had the added impact of the Russian invasion of Ukraine, had that to deal with. There was more of a direct impact, certainly to some of the countries there, but then the broader impact more to the global markets of commodity price spikes and so on. But so spreads did widen on US high yield bonds, but not dramatically. It was, so it really was interest rate risk that was the story in the first quarter. We have seen more spread widening here in the second quarter. There's been quite a widening here in the last month or so. Emerging market debt had the worst returns in non-core fixed income, largely due to that Russian invasion. If you look at performance here, page 33, page 44, it was, in context, it was a historically poor quarter for high yield bonds. And in one of our discussions with our managers, they said that there had not been 4 down months for high yield bonds in history. And now we're working on 5, unless something happens in the next week. So this is, that puts in perspective, what's been going on in the asset class. The bright spot was that each of our managers outperformed their respective benchmarks. In terms of performance versus the asset class benchmark, we underperformed, and that underperformance, I've said, I think every quarter, it seems like for the last 18 months, was due to the absolute returns of preferreds and emerging market debt. Both of those underperformed the asset class benchmark, which dragged us down somewhat below the asset class benchmark. No changes to our roster of managers, and no flows in or out of the asset class in the quarter either. Any questions about? Moving on to domestic equity on page 35. We have the same pressures, and interestingly enough, if you talk about duration, I think duration is more kind of a fixed income term, but the same effect had some interesting effects in equities that we saw first quarter, and this continued here in the second quarter, that higher bond yields and higher interest rates meant that high PE, high growth stocks were hit particularly hard. Their earnings, their valuations more dependent on earnings and cash flows further out in the future. With a higher interest rates, larger discount factor, that means those earnings further out in the future are worth less today when you get the increase in interest rates. And so what we've seen is a huge outperformance of value over growth year to date. In the first quarter, small caps underperformed large caps by a relatively small amount. So it wasn't necessarily a large cap, small cap story in the first quarter. It really was more of a value versus growth story. And here on page 35, the PE 19.5 times, that has come down. And so the story is not that earnings per share is falling. We're still getting earnings growth. All the returns have come, the decline in the stock market come from what we call multiple compression. It's a lower PE. So higher interest rates typically means lower PE. People are less willing to pay less than they used to for those same earnings. And so we've seen multiple compression quite a bit this year. Moving on to performance here on page 36, 37. The asset class had the slight outperformance, 6 basis points in the quarter. Underperformed the last 12 months by 23 basis points. Most of that came with our legacy active managers that we had in the second quarter of 21. And as we roll forward, that impact of the active management will, for rolling years at least, will disappear from that. We did have a small overweight to small caps. That was a small drag in the quarter. But really the driver was, we're more, at least for the quarter, that we mentioned in the asset class review, there are ways that index funds, we are now all passive, index funds can generate revenue, offset fees, and so we saw some of that. And that's what you see here in the first quarter with the slight outperformance. 38, we've talked about this before, the characteristics, we've been all indexed as of last November, small overweight to small cap stocks. No changes to our roster of managers in the quarter, and flows were just really limited to minor rebalancing activity that we did. Any questions about domestic? Page 39, international equity, really largely the same things. in terms of value versus growth, large cap versus small cap. With the impact of the Russian invasion, there was more of a direct effect on international stocks. International stocks underperformed US stocks in the quarter. And that effect would hit more, hit harder on emerging markets than it did developed. So developed markets outperformed emerging markets. You see here some of the returns there. In performance, page 41, the asset class underperformed the benchmark for the quarter by a little over %. Manager performance, I would say, was mixed. We had some outperform, some that underperformed, but really the driver was a single growth manager that accounted for a large part of that underperformance. This was a manager that had done extremely well prior to this period and has still done reasonably well since inception, but that explains a lot of the underperformance, at least in the first quarter. Again, similar dynamic.
Was that sort of expected? I mean,
That would be expected, I think. In terms of, if you told me, here's what's going to happen in the markets, like, yeah, it's probably, nothing unexpected in terms of their performance for that period. Again, similar dynamic in terms of value versus growth. The really the high growth, high momentum, high PE stocks bearing the brunt of bearing the worst in terms of performance for the first quarter. Page 42. Maintain allocation to both active and indexed, about a 50-50 blend there. Very small overweight to small cap stocks, even smaller overweight to emerging markets. And there was, as I discussed, I think the last board meeting, there was one manager that was terminated. That was two accounts with that manager that we had, and replaced. We hired a manager back in February. And outside of that, the flows were just limited to, again, like domestic equities, minor rebalancing activity to get us back closer to our midpoints.
question?
Yeah.
Bruce, there is a limit, not just a home committee. Rule. Just. You're nowhere near it, but I'm.
I give you some of mine.
Thanks, Jack. So it seemed to me that the currency markets have been also extremely volatile. And, with the Russian invasion and ruble now essentially the attempt to take the ruble out of the international currency market, has that added to the complexity of dealing in the international equity market at all? Because I know we talked before about the effects. You have to take the effects of the currency market into consideration on.
It would be more complicated for our managers because they see some of that volatility, and you see some really like Brazil in the first quarter, a huge rebound in currency. With all the other stuff going on in the world, you see a huge rebound there. So for the managers, it's more complicated. For us, stronger dollar means weaker international returns. That's the short story.
Axiomatic. Yeah. No, okay. So harder for them, but kind of predictable for us.
Not predictable, but it's not something that we're actively managing.
Yeah, okay. I'm sorry. It's wrong terminology, but you're saying the same thing that I'm trying to say.
Well, and when there's fear, there tends to be movement to the dollar because it's perceived higher quality, and also because we're ahead of other central banks in terms of taking action and raising interest rates.
That's also an influence on the dollar. This is really from left field, but did the cryptocurrency debacle have an effect in any way on our portfolio? Thank the Lord, we don't have.
I hope it didn't. No, I don't see any effects.
So that was an isolated.
Right.
Yeah.
We
You see over
don't
here.
have any,
Yeah.
you know, maybe within a manager or something, somebody's got a little piece somewhere, but it's.
No, I didn't think we did, but I just was wondering if it shook the more traditional markets.
Thanks. I think it was more the opposite, the traditional market.
Oh, so just what she was saying, now
Yes.
it's the safety factor.
Thank you.
Won't even tell you to open your booklets to my page because things have been happening in STIP so quickly that it's outdated already. Good news, the market value of STIP is up. It's about 7.5 billion after some stellar taxes coming in and some more federal money. The yield has doubled from what's in your book and then some, so we're just under 1% yielding in STIP. Reserving is up to keep it safe, and I'll take any questions.
What were assets?
7.5.
When we hit 8. Another crumble cookie run.
Opioid money is coming. So that'll be sooner than you think.
Taste culture.
Yeah, property taxes. We're on our way there. Awesome. Yeah.
So when you're at this portfolio,
Right, yeah.
Yeah.
weathered the storm.
Yeah.
So when the portfolio is getting this big, other than this bigger numbers, does it make your job more complicated?
It does, definitely. You know, state flows are bigger. Takes more time in the morning to find things because we're not the only person getting money lately, federal governments and things. But luckily the team is super strong. I was able to go on a long weekend vacation and John Carpenter and Kelsey took care of everything with John in charge, you know, making sure they're pushing the buttons right. And that was, you know, huge. It was a relief. They texted me once to tell me the money came in for ARPA and that was it. So, yeah, very nice.
Remind me again, and I forget this every time. What is our reserve limit? I mean, so we've got now more than the 56 million, but
Yes.
what triggers when?
We are trying to get to 1.15% of the balance. And so we're currently reserving, trying to get there within 3 years.
I just can never remember what that is. Yeah, try and remember.
No worries. I don't know, I see Jeff off.
The length of that presentation.
Yeah, anytime. Speed through it.
Jeff, did you have something?
Did I know? I just unmuted
Oh.
just in case.
You're not waving goodbye, are you?
No, I'm still here. So.
Okay, well, thank you. Oh.
Fair enough. Fair. If I can refer the board to slide 45, state fund. State fund had a modestly negative return over the year. Obviously, bonds had negative returns, but with the equity and particularly with the real estate asset class returning close to 21%, they ended up close to zero. The portfolio outperformed the benchmark by 57 basis points over the year. The investment grade portfolio outperformed the index by 82 basis points, again, being short duration, but somewhat overweight spread product. I would also note that we did sell about 20 million equities in May. Any questions? Of May of 2021. In the prior year. Of equities, right? Any questions on state fund?
How's your relationship?
Spectacular, never been better. Oh, it's good. I mean, John and I went over and met with state fund and had a productive and board meeting. Look forward to future meetings with staff and the new CEO. Hopeful. Going on to trust fund on page 47. The pool underperformed its benchmark by 41 basis points on the year. That was driven by fairly what would appear to be fairly dramatic underperformance of the real estate asset at 336 basis points below its benchmark. The internal portfolio did outperform by 78 basis points. But I want to circle back if we could to real estate. And I don't think that, you know, the relative underperformance is really the message we want to end on. A couple of things I would note about that is the board will recall they increased the top end of the real estate asset class from 8% to 30% in February of 2020. We had told the board that, you know, a reasonable time frame to get to where we wanted to be in the higher end of that was 3 to 5 years. Shortly after that, we thought we saw great opportunities to go faster than that, and we asked Ethan and team to go whole hog into that. And then in March 1st, about when all COVID blew up, we said, wait, no, we didn't mean it. Don't do it. And so a little bit of schizophrenic instructions to our real estate team, but they handled it really well. And then subsequent to that, there were we felt very good opportunities to go into real estate. And so we accelerated that timeline significantly. So if I could refer the board to slide 84, please. We can see the relative contributions to performance. 84, please. Yeah, so
Second
all
from
the
the
way
last.
back. I'm sorry.
Second from the last, I was just helping Bruce.
I just wanted to point out the relative contribution to total return that we saw from real estate in the trust fund, and it is by far the large majority of return or ROIs that came from real estate, and less so over longer time periods. But again, that's because we are much lower asset allocation to real estate in prior time periods. So I think the good message to the participants in trust fund is, yeah, we went heavy into real estate right before it returned historic returns. Ethan claims that won't continue. You know, I hope it does, but that's on him. But one of the things that will, I think, continue going forward is one of the big reasons that real estate went up so dramatically is because rents went up so dramatically, and those rents are what we will pass through to the trust fund and participants, and so it's a good story to tell. Any questions?
The perspective of the participants, you know, the relative performance, they don't care. They care about cash distributions. So from a cash distribution perspective, we're up from where we were, particularly in those for those funds which didn't have exposure to real estate prior to 3-4 years ago. You know, on a dollar for dollar basis, they're all net ahead.
In that regard, I did want to call out, it was the reasons for the underperformance are mainly because we are new into most of these funds, and and you know, from private equity and real estate, there's a J curve effect. Well, proportionately, we're much newer than the index, and so we're working through some of that J curve effect. Also, we were in some real estate debt and commercial mortgage-backed security funds that we always knew weren't going to yield the level of core or plus funds, but still higher than bonds, and so expected that to happen.
Questions? Great presentation. Okay, we're on tab 5, I think. I appreciate you coming back. The reason I said, you know, it's been more efficient to do it when you're here before, but try to keep to the schedule in case somebody wants to look in or whatever. So thanks for coming back.
Yep, no problem. Tab 5, Angelus Equity Partners Fund 2. This is an existing relationship. We re-upped into Fund 2. They are a small size buyout manager. We define small size as $0 to $25 million of EBITDA. So relatively small and an exposure you wouldn't get in the public markets. Met with them on site in December of last year to Bruce's questions regarding traveling and on sites. Know the team well. We have an LPAC seat on Fund 1, so I've been engaging with them over the last couple of years. Also have an LPAC seat for Fund 2. Made it $60 million. It's much higher than we did for Fund 1, but on par with our pacing and commitment sizing for buyout managers in the past couple of years. Some standout things you might notice is the management fee. It's a negotiated 1.75 compared to the cover 2% management fee. We got that fee because of our size, but also because of our existing relationship. So no one else, I believe, will have that management fee.
A good performance in the previous fund, just on a real high level. What caused that?
I would say their performance is strong on a relative basis. 19% IRR is not even that high compared to some of the buyout managers we presented recently, where you've seen 20s and 30% IRR. I think Angelus on a risk-adjusted basis is really interesting. Their focus is looking for value and creating returns through operational value add. So if anything, they have been very conservative over their investment period and probably not taken on as much risk as other managers that are willing to pay higher prices for deals, where Angelus was quite frugal and they had a harder time finding, these diamonds in the rough. And so they, I had a criticism of them, and which I've expressed to them before, is they didn't deploy capital very quickly compared to some of our other managers. And so, they've created value. The first 2 deals they've exited in their portfolio have returned a 3x multiple of invested capital. You don't see that here, and the IRR doesn't reflect that because that's timing. But, they are creating value and returning large multiples of invested capital, not just the IRR. So we're looking at multiple dimensions of returns. But I think they are good at what they do. their returns probably could have been higher over the last couple of years compared to some of their peers. But I think they are taking much less risk for the return that we're getting.
Thank you.
Michael, is that an unusually small staff to have that much asset under management, or is that
No, I think that's
abnormal?
on par. Yeah, this would be considered a relatively small fund. And so that's a normal amount. I think if anything, their back office was a little bit lean. And we've expressed that, and they're building it out. I think they've recently hired a controller to support the COO. But pretty normal, if not, maybe even large, depending on the strategy.
Anything else? Okay, well, thank you.
Thank you.
Dan, do we have anything we need to do?
Not tonight, 9:30 tomorrow, back in here. Yeah, that's it.
Well, thanks, everybody. Meeting's adjourned.